gives me great pleasure to welcome you all to this special session on Union Budget, NRI Taxation and the new Direct Tax Code 2025. I, CA Ashish Subedar, CB Committee Lead, Oman Chapter of ICAI, welcome you all to this great morning. Today, we have the privilege of hearing from two distinguished experts who will provide valuable insights on today's critical topic. First, we have CA Manish Dafria, who will share his expertise on Union Budget 2025 and NRI taxation. Following his session, our esteemed past president, CA Nihar ji, will delve into the intricacies of new direct tax code. Before we begin this event, we would like to thank His Majesty Sultan Haitham bin Tariq, our sponsor CBFS, and our corporate supporters and corporate members. May I request all to stand while we play the ICAI motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा
May I now request Chairman CA Gaurav Kapoor for his welcome address.
Okay. Good morning, everyone. It gives me a heartily and warmly welcome you all on this special budget session where we are trying to cover both the Direct Tax Code Bill 2025, which has been recently tabled in the Parliament, as well as the budget for 2025 and NRI taxation. We have two eminent speakers on this occasion. First is CA Nihar Jambusaria ji. I'm sure you know him all very well. He has been in Muscat before, and we have the privilege of his brother being a member of our chapter as well. So welcome, Nihar ji. I also welcome CA Manish Dafria ji, Managing Partner VK Dafria and Company, who is going to take us through the budget and the NRI taxation provisions, not only what has changed in this budget, but overall that you should be aware of. On the direct tax code, the first direct tax code was introduced way back in 1961, which ultimately became the law and is still ongoing. So it has been there for quite some time. And to change that was first thought of way back in 2009. I'm just saying this based on my research. I may be slightly wrong, but Nihar ji can correct me. But then the things kept on developing from their end, and the government needed to have a strong motive to revamp this tax law, as obviously it was complicated as well, and therefore, sorry, I was just getting calls from UAE because we have Abu Dhabi chapter annual conference today starting, so they wanted me to be there, and I said, no, I have to first be here for this event, and once I finish this, then I will be there as well. So apologies for that, I'm getting calls in between. So the first preparation for this new code started way back in 2009, and as I said, it wanted to have a great effort from the government side as well to bring this budget, the direct tax code to life. So here we are. It has now been tabled in the Parliament and looks like it will fall through. So we'll leave it to Nihar ji to comment. But what I do understand that it is trying to cover 5 key aspects. Number one is simplification of the tax structure, rationalization of the tax rates. To some extent, it has started 2 or 3 years ago when with the old regime and the new regime, probably at some point of time, the old regime will go away fully. Focus on digital economy, transparency and compliance, and last also to boost investment, because and this is what as a tax consultant, I also say that most of my clients would not say that they do not want to pay tax, but if there is an ambiguity and they have a chance to save it, they will say, I better not pay it, right? So that's where the planning for tax also comes in. So this rationates to the fact that when a businessman or a corporate makes an assessment to invest in a country, the taxation system of that country is very important factor. And the more important is how clearly the tax is defined. Right? So that's where it is. I will leave to Niharji to comment whether the direct tax code changes are resonating to bring these to life, or there will be more things to be done by the government. At least the first step has to be there. I'm sure as the government also thinks about it and gets more consultation, it gets live, there will be a lot of amendments that will take place during the course of coming years. So this is for today. We just had our GCC conference, the first GCC conference, which had been a great success. Thanks everyone for that. And I would also thank you all for your support throughout the year, which enabled us to win the Best Chapter Award for the 10th year in consecutive. Thank you very much for that. Coming to the future, so we'll have 2 or 3 events lined up, so I'll embrace you on that part as well. So we have one is a badminton tournament coming up on 28th of Feb. It's next Friday. Ramadan is expected to start on 1st or 2nd, so we thought we finished that before. So that's the last opportunity we had. We planned this session a week before, as most of you would know, but then there was a delay on placing of the direct tax code, and us as well as the speaker getting the access. So it would not have been possible, to do a session just when you get an access 48 hours before, or to have even a meaningful discussion on that. So I'm sure today we will have a much better coverage of that topic as well. And as I said, Ramadan would be starting 1st or 2nd of March, and as we always do Ramadan Iftar, we will be doing that as well. But this year, because it's happening in March, and in March we also have International Women's Day, so we will have International Women's Day and Iftar clubbed together for all of you. It's planned for 12th of March, and we will have definitely a special guest or a chief guest for that day. Any guesses? Apart from not the managing committee or people in the CP committee to answer that. Okay, I know if I say any guesses would be too wild, too wild to make a guess. We sent an invitation, but she's too busy, she gets lots of invitations. I think we need someone more, no, let me not comment on what more it is. So, okay, I'll give you a hint. She is a retired IPS officer. Come on, so I didn't have to give the second clue about it. So be prepared for it. So we hope she is fully well, and as of now she has confirmed and would be here on 12th of March. So please block your calendars for that. Up to 31st March, we'll probably have one more Ramadan cricket or some other sports activity. So we'll conclude with that up to the end of March, and then obviously we are planning for the future events as well once the Eid break is over. Thank you very much for that, for joining us today, and I hand over back to Ashish to take it forward. Thank you.
Please be on the stage, Gaurav ji. May I now request CA Nihar ji and CA Manish to be on the stage. We'll welcome you with the. We earlier used to give flower bouquet, but then we started this new concept, grow it yourself. So it has a seed, fertilizer, and little pot also. So you can, especially since you're traveling from outside, carrying flower bouquet is not really possible. So this will be more, so you can.
Not possible, to be honest. No speaker has carried it back. After going this over, in the car they used to say, Gaurav, go and give to your wife, or whoever drops at the airport gives the gift back. So we changed that. We're trying to change that pattern. So that they take it along and then give it to their wives and not.
And I request CA Gaurav to Nihar. I request Vice Chairman CA Unmesh to welcome CA Manish with Grow It Yourself.
Nice concept. Very nice concept.
MC on the stage, please. For the GCC seminar, we started with audio visual for speaker introduction, so we are trying to use the same. So we'll start with first session is by CA Manish Dafria on union budget and NRI taxation. We'll start with Manish's introduction and then he will take over.
CA Manish Dafria is a chartered accountant and academician, serving as managing partner at NSBK Dafria and Kobe in Indore. He is a visiting faculty at IIM Indore, teaching strategic tax management, management accounting, and GST impact on supply chains. He also teaches at the Indian Institute of Corporate Affairs, National Academy of Direct Taxes, and ICAI's DASA course. With over 3,500 hours of teaching experience, he has trained CEAs nationwide and conducted workshops for income tax officials. He has been a member of ICAI's Direct Tax Committee and the Regional Direct Tax Advisory Committee. Additionally, he has delivered lectures for the Income Tax Department, MP State Tax Department, and MP Police, contributing to public awareness and professional education. We welcome our esteemed speaker to this beautiful city of Muscat and address our members.
Good morning, everybody. Members of Managing Committee of Oman chapter of ICAI, President Gaurav Kapoor ji, Vice Chairman Unmesh ji, who is actually responsible of, say, I being here, continuously chasing me, coordinating with me, giving me all sorts of, say, advice and everything. All other Managing Committee members, Honorable Past President of ICAI, Shri Nihar Jambusaria ji, seniors in profession, friends. At the outset, let me express my heartfelt gratitude to be speaking from the dais of a chapter which has continuously received award for best chapter from ICAI continuously for 10 years. It's an honor, sir. Let me be very clear on this. It's a real honor. I come from a city of Indore where we have got, say, best branch award of the institute for consecutively around 7-8 years. It's a cleanest city of India for again continuous 7-8 years kind of thing. So I can understand the kind of, say, commitment it needed, kind of, say, devotion it is needed, not only from the managing committee but from every member of the chapter. So it's really an honor. And then I'm also conscious of the fact this is probably the platform from where, say, stalwarts of the profession have spoken earlier. Unmesh ji was mentioning, Bhupati ji was here, T. Manoharan Saab was here. Today we will be having, say, another stalwart of the profession, Nihar bhai. So it's actually an honor to share the dais with you also, sir. So it's a moment of, say, great pleasure for me. And then I'm really thankful to ICAI Oman chapter for giving me this opportunity. Thanks a lot, sir. Two different roles probably I'll be playing today, two different aspects of discussion we will be having. Unmesh ji has mentioned. So first of all, with respect to budget 2025, we need to discuss something. And then of course, this whole issue about NRI taxation, various aspects, nuances of this whole NRI taxation. So I thought let me first start with this budget 25. Because with respect to budget 25, my job has been actually taken by in this whole budget. Earlier, we used to have all finance bill and amendments running through say 100 or 200 or 300 pages kind of thing. And this time we were having something very small kind of finance bill, some very limited number of amendments, because the direct tax bill was going to be presented, and then it has been presented in fact say after 10 days from the say day of budget. So probably Nihar bhai would be giving us a say better idea into what exactly the changes which are going to happen with respect to this whole income tax from years to come. But then whatever changes they have made with respect to finance bill 2025 itself, I'll say some aspects of that particular those changes which have been made through finance bill 2025, and then we will come to this particular discussion about NRI taxation. Okay. So as we all know, this budget 25 has been presented in the backdrop of some very say big global changes which are happening. That the whole world economy is kind of going through a turmoil with all these say new government in USA and trying to do, nobody knows what they are up to in doing next day, what will happen. So all these kind of changes earlier, I think lot many seniors sitting here would be able to recall. So we all have grown in the era of when of what is called liberalization and globalization. These two used to be the say keywords during the course of our say growth in the profession. What we are finding as of now, probably these two concepts are no more relevant. Every country is looking more and more inward kind of thing. Tariffs they are proposing, all kinds of say retaliatory measures are say being taken by countries against each other. So all those kind of say global economic issues were there, in the backdrop of which this whole budget has been presented by Finance Minister. So far as income tax is concerned, she was always already having this new income tax code in her hands by the time she has presented the budget. So there was nothing much was to be done by the finance minister. But then, as happens, politics always overtake economy. So when you present a budget, when you are say trying to discuss all these economic aspects of the country, you always have some political compulsions. On 1st of February, the budget has been presented. On 5th of February, we were having this elections in Delhi coming up. Middle class is something which is a say very powerful voter lobby, at least and in some pockets of the country, Delhi amongst one of them. So obviously there was something required to be done to placate the middle class. There is a growing tendency in India as of now that these are salaried people who are paying huge amount of taxes, but the tax base is very narrow, around say 130 crores population, out of which only say 9 crores file their income tax return. Out of these 9 crores, only 4 crores actually pay the taxes. So there was a growing resentment kind of thing, specifically amongst the middle class, that we are doing a say huge amount of load bearing so far as this taxation is concerned. Then there was this report which has mentioned that personal tax collection in India has outgrown the corporate tax collection. So individuals are paying more income tax rather than corporates. So that has added to what is called fuel to the fire. So whole lot of say social media issues and whole lot of posts going around and a good amount of say resentment amongst the middle class actually looking based on the say the kind of say tax burden which was there on the middle class. So government thought, finance minister has thought, let me do something to placate this whole middle class, provide them some kind of a relief which they will always keep on talking. And this is what she has essentially done. That the main aspect of this whole budget 25, that the main focus or probably the key change which they have made in this whole say Finance Bill 2025, I am sure even in Muscat also, you must have got all those say huge amount of social media forwards and WhatsApps coming to you and LinkedIn about this whole change in the say the amount up to which tax is not payable. Okay. So till last year, this was something around 7 lakhs of rupees up to which no income tax was payable in India, and now they have raised it directly to something around 12 lakhs of rupees. So what exactly are those kind of changes? We are having some discussion on all those things. As I mentioned, not many of the changes, some of there with respect to transfer pricing issues, some of there with respect to some simplification for charitable organization, all those. I will not be burdening you with those kind of changes. I will be restricting my discussion only on those points which are having some relevance for all of us as an individual taxpayer from of an NRI, the perspective of a say understanding of taxation related, which have come out through this budget 25. So probably I can start with the say change in this slabs of taxation. Mr. Kapoor was mentioning there is this whole idea about say new tax regime and old tax regime, and then probably old tax regime will not be relevant after some point of time. Sir, let me tell you, it is already dead. It is gone. We all should be very soon writing nothing less than obituary to this old tax regime. Gone are the days where we used to have all these kind of deductions. We all, I'm sure we all must have say learned them by our heart during our CA final studies and everything. There used to be something called a LIC premium payment deduction and health insurance premium deduction, and then all these say self house property interest deduction, and all those things. This is gone, sir. Practically it is gone. It is there in the statute, it is still there, but I'm very sure rarely anybody would be finding any merits to go for that what is being called old tax regime. Okay. One thing what we all have observed with respect to this say Indian government since last 10-15 days, 10-15 years actually, if they have to market something, sir, they will market it like anything. If they have to sell something, they will sell it like anything. So once they have decided this is new tax regime which we have to sell, so they will create all sorts of incentives, all sorts of say favorable situation in order to sell that particular product in the market. As a tax professional, we can always keep on discussing merits or demerits behind say having this kind of regime, discouraging the savings in the country, not say incentivizing the various kind of investments made by the taxpayers, but they have made up their mind. This is the way we need to take it forward. So what they have done with respect to this new tax regime, they have created these two changes from this year onwards. One is this tax slab. Now what they are saying, say with respect to this new tax regime, first 4 lakhs of income, they are saying no tax liability at all. This will be 0% tax for the first 4 lakhs. And beyond this, this is simply a table of 4. 0 to 4, 4 to 8, 8 to 12, 12 to 16, 16 to 20, 20 to 24 and beyond 24, 0%, 5%, 10%, 15%, 20%, 25%, and then the highest rate of taxation, 30%. So the simplification in language, okay, you don't need to say refer to any website, go to Google or something like this. It's a simple table of 4 you recall, and then 0%, 5%, 10%, 15%, something like this. So this is what is the say first change which they have proposed, enhance these tax slabs specifically only for this new tax regime kind of thing. Old tax regime still the same slabs, which I'm sure nobody is able to recall nowadays. What were those slabs? So this is the first change with respect to change of, say, rates of taxation. Then this whole idea about this tax relief which they have given, this whole section 87A, what is being called the rebate with respect to income tax. First of all, if you are trying to understand this whole 87A 12 lakhs exemption from your personal taxation issues with respect to income tax, then probably I have a bad news for you. This whole 12 lakhs exemption is not applicable for non-residents. It is only for the individual resident in India. So something which is a matter of joy in India probably may not resonate that much kind of happiness in this particular audience. So the section is very clear. It starts by saying, in the case of an individual resident in India, this whole mechanism would be applicable because this is the point which needs to be appreciated. So what happens, I'm taking all these, say, budget sessions since last, say, 12, 15 years kind of thing. Since last 5-10 years, I have probably last 4-5 years, I have added one more thing to my responsibility, just to clarify what is there in the budget, and more to clarify these confusions which have been created by so-called WhatsApp University or social media and all those things. So after this 12 lakhs relief has been announced, every newspaper in India, there was this headline that the exemption limit has increased, no tax liability up to 12 lakhs. In the gathering of tax professional, we need to have an absolute clarity. This is not an exemption, sir. 12 lakhs is not exempt. It is not like this up to 12 lakhs 0, then beyond 12 lakhs 5%, something like this. It's a rebate which they are giving. Till last year, they were saying this rebate would be available up to 7 lakhs of income. Now they are saying it is available up to 12 lakhs of income. Meaning thereby, if my income is up to 12 lakhs of rupees, you will be calculating my tax liability, and then whatever is that tax liability, you will be allowing a rebate of that total amount to me. So there is nothing like exemption. And that's why, if I am an NRI, because they are not covering me into that particular section, so for my tax calculation purposes in India, I'll go back to those normal slabs up to first 4 lakhs, no tax liability, and something like this. Okay, so 87A relief they have introduced, but then I'm sure you must be having, say, good number of, say, friends, relatives, others in India who might be, say, talking to you, trying to get some sense about this whole, say, rebate which they have created. So what exactly is this idea? Section 87A of income tax is what is taking care of this whole, say, no tax up to 12 lakhs. It's a rebate. Income is up to 12 lakhs. You, whatever is the tax liability, the 100% of tax liability, you get a rebate. If the income crosses more than 12 lakhs of rupees, then this rebate would not be available. But fortunately, they have introduced this concept of marginal relief also. So if income is more than 12 lakhs of rupees, my maximum tax liability would be restricted up to the excess of income over 12 lakhs. So for example, the income is something around 12 lakhs 40,000 rupees. So if you you are not entitled for this 87A rebate. If you calculate the tax liability as per tax slabs, it comes to something around 95,000 rupees. Now they are saying excess of 40,000, we will give you a rebate. So if income is up to 12 lakh 40,000, you will be paying tax only 40,000 rupees. So this is what is this whole concept of marginal relief which they have introduced, about which there is again a, say, great amount of misinformation has been spread. Many of this so-called social media influencers have started raising this issue. This is discrimination, not fair. But there is this whole concept of marginal relief. Okay. Just to make one small point clear, that if income is, say, for example, 12 lakh 40,000, Though it is being said, the finance minister has also said on the floor of the parliament house itself that tax liability would be 40,000 because of this mechanism of marginal relief. But then still even she is confused. The taxation is such a matter only a chartered accountant can understand clearly, otherwise everybody else would have their own share of confusion. So if my income is 12,40,000, you will give me a marginal relief. So considering that marginal relief, there would be a tax liability of 40,000. But then those of us who are having a clarity about income tax, we also know that there is a concept of education cess also. So on that 40,000 of tax, there would be a 4% of education cess, making my actual tax liability 41,600. It might be a small amount, sir. But I am sure if in CA final examination I write an answer ignoring that margin, that education cess, I'll get a 0. So she may say it on the floor of house that this is only 40,000 which is payable, but as a tax professional, I know that there is a education cess also that needs to be taken into account, and that will inclusive of this will be my tax liability. Okay, so this is about this 87A relief. One more catch which they have introduced, and this also we know, any tax law, unless you read the complete section, the catch would always be there somewhere at the end. This is what we have been told. Don't form your opinion simply by reading the heading or simply by reading the first section. Read complete one. You will always find some twist happening at the end of the section. So what they have said with respect to this 87A relief, that this whole rebate would not be available, or rather it would be available in respect of those income only for which the tax is calculated under that new tax regime rate, that 115 BAC rate. 115 BAC is this new tax regime section, meaning thereby. Now, this is something interesting, sir. This is again the way we have been taught. When I recall when I started reading my income tax, my senior used to tell me, yeah, Manish, in income tax, what is there that is important. Sometimes what is not there that is more important. You need to read the law as if what is there that you need to understand. What is not there, sometimes that needs a detailed understanding. So what they have mentioned, that this whole 87A rebate would be available with respect to income on which the tax is calculated under section 115 BAC. Now, sir, in my Indian income tax, I have number of other income where the tax is calculated under different sections. For example, there is this whole idea of long-term capital gain, where I have got a separate section, section 112, 112A. There is the short-term capital gain with respect to security market transaction, for which I have again got a separate section called section 111A. So when in 87A rebate, you are saying that this would be available only in respect of 115 BAC income, meaning thereby you are leaving all other income out of this section. So it is again for the general public, this is good to understand, this is good to say up to 12 lakhs of rupees there will not be any income tax liability in India, but as a tax professional we need to appreciate this is not 100% true. This is subject to certain exceptions. So say for example, okay, somebody is having income of something around say 7 lakhs, 8 lakhs rupees plus 4 lakhs rupees of long-term capital gain or a short-term capital gain. On this capital gains income, the tax liability would be there, even if your overall income is up to 12 lakhs of rupees, but still on these capital gains income, or for that matter, there is a cryptocurrency transaction, some kind of a lottery income, which all are taxable at special rate. So for all these income, the tax liability would still be there, even if your overall income is up to 12 lakhs of rupees. So it is good to say in the parliament that we are doing this, good to have all these newspapers carrying these headlines, but say this always happens in taxation. So whatever you see it may not be true every time. Jo dikhta hai, wo hamesha sahi ho, it is not necessary. So this is what is the position with respect to this 87A. Now coming to sir another very important change, and this is probably where I feel good number of focus should be there from say NRI's perspective also. This whole concept of gift city which has been introduced in India since last 7, 8, 10 years. They have established this whole gift city somewhere in Gandhinagar, Gujarat, came out with a separate regulation for this, International Financial Services Authority, IFSCA, a separate regulatory authority they have created. And as I have said, the government of India is marketing it a lot. They are promoting it like anything. They just want to have Gandhinagar equivalent to say next Singapore kind of thing. So every year we are finding good number of changes happening, enabling provisions are being made in order to facilitate that whole concept of gift city. Not going into much of the details of this, but just to give you a very brief idea that regulatory authority they have created for say regulation of this whole gift city, that is a kind of super regulatory authority. It has been given power to override RBI, to override SEBI, all these financial market regulator. This IFCA would have a say overriding power over all these financial market regulator. So it's a kind of say separate mechanism they are creating. Good number of say incentives they are providing to the say units situated in this gift city. Good number of, as I have said, enabling amendments which are being made. Every year, not only with respect to income tax, but with respect to other financial legislation also, there is a good number of incentive which are being given to that gift city. Okay, so from a non-resident perspective, probably you may like to have a say further analysis of this whole idea of gift city. It may require a very detailed kind of discussion at a different point of time, but I may mention this thing. There's a very good say financial development which is happening in the regulatory aspect in India, this whole gift city. Okay. So one change which they have introduced from this year, number of changes are there even in this budget also. Most of them are related more from say various say investment funds and say those aircraft leasing companies and those things. From an individual perspective, one very important change with respect to this gift city, that is with respect to life insurance policies being issued by insurance intermediaries situated in the gift city. So as an NRI, for example, you want to purchase a life insurance product, a life insurance policy. In India, we have this section 1010D of income tax, which talks about exemption with respect to this life insurance policy. And over say a period of last 3-4 years, they have made number of changes with respect to that life insurance policy exemption. One change which they had introduced 2-3 years back, that if my premium with respect to that life insurance policy crosses a particular amount on an yearly basis, then the amount which I will be receiving, that will not be eligible for exemption, that will be taxable. Okay, the premium amount which they have decided was rupees 5 lakhs, INR 5 lakhs of rupees. So my yearly premium is more than 5 lakhs of rupees, then the insurance policy amount at the time of maturity would be taxable. Okay, they just wanted to cap those high premiums. Now, when they are creating this gift city as an international financial center, trying to attract say non-resident investments a lot, then a say suggestion has been given to the government that with respect to Indian insurance, now you are having this restriction, annual premium should not cross 5 lakhs of rupees, otherwise we will tax the maturity proceed. Now this makes Indian insurance companies uncompetitive vis-a-vis say foreign insurance companies. Okay, so as an NRI, if I purchase a say life insurance policy from an Indian insurance company, I'll be subjected to this 5 lakhs kind of restriction. So rather than buying a life insurance from Indian company as a non-resident, I may then go to UK, I may go to Germany, I may go to say any other say foreign insurance company. I can purchase the insurance policy from those foreign insurance companies also, because here in India, if this 5 lakhs cap would always be there. So in order to provide that level playing field, now they are saying in respect of any non-resident, if I purchase any insurance policy from a say insurance intermediary situated in gift city, then that restriction of premium would not be applicable. Whatever is the amount of premium paid, the life insurance policy maturity proceed would always be tax free under the Indian Income Tax Act. Specifically for NRIs, this amendment they have introduced from this year onwards. Okay. But again, I would like to emphasize, earlier also, this is what we are discussing about this year. Earlier also, good number of changes they have already made with respect to this gift city. So probably as a non-resident Indian, this whole gift city should be an idea on the radar of everybody. What exactly is happening, what kind of incentives they are creating. It would be good to have a say detailed understanding about this. Okay. Now, coming to some further changes which they have introduced, there is this presumptive taxation system we are already having in India. Number of businesses income is taxed on a presumptive basis. One amendment they have introduced with respect to non-residents this time. India is this whole manufacturing nowadays, okay, we are trying to say follow a policy of what is being called China +1, all those manufacturing which is shifting out of China. So government of India is trying to get us a greater of that whole manufacturing activity in India. Based on this, we have got this whole Apple manufacturing unit coming in Chennai, number of say other manufacturing. This whole concept of PLI, production linked incentive, is a very fabulous scheme they have formed with respect to this whole manufacturing. One area of manufacturing which they are emphasizing a lot is all these electronic goods. So with respect to this, there is one amendment which they have introduced. Any non-resident, what is happening, this whole electronic good manufacturing unit getting established in India, there would be some foreign entity, some non-resident entity which would be providing technical services with respect to this whole electronic manufacturing. So how those income would be taxed, that non-resident is providing this whole technology services, etc., with respect to electronic manufacturing unit in India. So how the income of non-resident would be taxed, they have introduced this presumptive taxation. They are saying whatever is the gross receipt of that non-resident with respect to supply of services for electronic goods manufacturing in India, 25% of that gross receipt would be treated as taxable income in India. So whatever is the gross receipt, if say it is $1 million kind of say services somebody is providing, a non-resident to India, out of that $1 million, they are saying 2.5 lakhs dollar, 25% of this would be treated as taxable in India. So say if this happens to be a foreign company, this 25% would be taxed at the rate of say 40%. So effective tax liability comes to around 10% only. This is what is this complete calculation they are giving with respect to this electronic manufacturing industry, a non-resident providing technical support, providing technical services, etc. Something regarding those of you who might be having some investment in what is called ULIPs in India, Unit Linked Insurance Plan. So now this whole ULIP maturity proceed has again become taxable in India because of some amendments made in the earlier year. There was always this discussion, if this ULIP gets matured, how this income should be taxed. A normal insurance policy proceed, if at all it is taxable as income from other sources, okay, those 5 heads of income. So there is this income from other sources. With respect to ULIP, where this would be taxable, it has been represented before Government of India that this ULIP, unit linked say insurance plan, it has got a huge amount of say investment component involved. Okay, there is a huge amount of market linked return involved in this whole ULIP. So now they are saying whatever is this ULIP income, that will not be taxable as income from other sources. This would be taxable as a long-term capital gain. Long-term capital gain, that too under that section 112A, 12.5% would be the tax liability in respect of ULIP maturity proceed. Okay. One amendment they have introduced with respect to this whole say startups. Again, India, another sector. Yes, sir, please. Please, please.
So, with regard to this ULIP, I think these are policies issued after 2010, right?
These are policies issued after
2010.
Okay.
For this conversion to 12.5% tax rate.
No, 12.5 is the say general rate of tax for all long-term capital gains. Any transaction happening after 23rd of July 24.
So ULIP gets into this category for policies issued after 2010. I just need to clarify this because there are some policies, probably 20-year policies, that are pre-2010.
Okay, yeah, fine. Say I got your point. The point is ULIP per se becomes taxable only when the ULIPs have been issued after 2010. I'm not sure with the date. I'm taking whatever you are saying, but there is this cutoff date. The ULIP issued prior to that particular date were altogether exempt. After this particular date, if ULIPs have been issued, then they are taxable. Now the controversy was this: if they are taxable, under which head they would be taxable. So now they are clarifying this would be taxable as long-term capital gain. But there is definitely a cutoff date.
So my
Yeah.
question here is that they said this amendment is applicable for policies after 2010.
Right.
It seems it's valid for policies issued prior to 2010. So for someone who's probably had a ULIP policy running for the last say 20 years and gets a good bulk amount maybe 5 years down the line, but issued prior to 2010, that amendment is silent over there.
The point is why this amendment is not talking about those policies, because they are not taxable at all. This amendment is not creating a tax charge. The tax charge had defined the head at which this will be taxable. Okay. So the policies issued prior to that cutoff date, because there was no taxability at all. So there was no need for this amendment to talk about those policies like this. Okay. Now, I was talking about this whole startup issues. Government of India is again, as probably all governments of the world are looking at this whole startup in a very big manner. So what is there? There is this whole one particular provision in income section 80 IAC, which talks about say 100% exemption to startups for the say 3 years in a period of first 10 years. So till now they were having this say 31st March 25 as cutoff date with respect to the of functioning. In order to be eligible for this exemption, or I can have hand mic. Yeah, hand mic. Video, there will be a I can just mention before 2000. I can just mention before 2009 there was 97 also, sir. I have read that income tax bill also 97. this time it has woken up, sir. Okay. So regarding the startup, what they have done, the eligibility period to say commence the activities, they have extended till 31st of March 2030. You commence a startup by that particular date, you will be eligible for this exemption, 3 years profit, 100% exemption. But again, there is a problem, and this is how say the mischiefs created by income tax. On one hand, they say we will be giving 100% tax exemption to startup, whatever is income, 100% tax-free income kind of thing. We all know in income tax, there is say another provision, a sleeping tiger kind of thing, what is called MAT, minimum alternative tax. If you give me an exemption under section 80 IAC, still the MAT is applicable, and MAT is applicable with full force. So for every startup, what happens again, all these income tax decisions one take based on this WhatsApp news or say social media or say Google Devta or all those things, they are ultimately going to land up in a big problem. Anywhere you see all these say Indian startup related websites, and everybody would be say talking a great about this exemption, 10 years for 3 years, 100% income tax free, 100% income tax free. Nobody talks about this minimum alternative tax. Even if you are exempt under that particular section, MAT is in any case payable.
Probably they would have forgotten about MAT.
Probably they themselves don't know about MAT. But it is there, sir. In our professional capacity, we are having at least 5 clients facing the very same issue, done everything to get this exemption, and then when we say it's taken up their ITR filing, we mentioned, boss, this exemption is available, but MAT will be payable. And client is like, sir, what is this? They are saying no tax liability. The startup India is talking about zero tax liability. I have talked to this, I have talked to that. Everybody is saying zero tax, zero tax, zero tax. Why you are saying? I am not saying anything. This is what is the income tax law of the country. This is giving this particular provision. Even if you are exempt there, still the MAT liability would always be there. So the exemption they are giving to these startups only from the say normal tax liability perspective. MAT in any case is going to hit, and it is going to hit like anything. See, for the client, a tax is a tax. You pay it under the normal provision or you pay it under the MAT. He may not be able to appreciate the difference. Ultimately, this is money going from my pocket, okay, by whatever name you call it. If tax is payable, it is payable. So this is what is the situation. Exemption from the normal tax liability, but MAT will always be there, okay. So one very important amendment is with respect to updated return, and that I feel need again some serious discussion from say non-resident perspective also. I have covered it into this presentation also, but we will discuss it with respect to these changes to budget, updated return concepts. 2-3 years back, they have introduced this whole concept of updated return in income tax. Normally, the deadline for me to file an ITR is 31st of December of the assessment year. The concept which is now going to abolish, okay, after new tax, they will be coming to tax year also. But right now, to say for example, this is financial year 23-24, the last date up to which I can file my income tax return is 31st of December 24, which is gone. Now what they are saying that I can file income tax return even after this deadline is over through the mechanism of updated return. Okay. Till now, this updated return could have been filed up to 2 assessment years from the end of the original assessment year. So for example, if we are talking about AY 22-23, the updated return can be filed up to 31st of March 25. So somebody who couldn't file the return in say for AY 22-23 on time, then this return can be filed till 31st of March 25. There is some additional tax which is payable. Now the first thing, what change they have introduced from this year, now the updated return instead of 2 years, it can be filed up to 4 years. So for example, if we are talking about again an example of say AY 22-23, now the updated return for AY 22-23, that is financial year 21-22, that can be filed up to 31st of March 27. that will be the time limit available. Along with this updated return, some additional tax is also required to be paid. The percentage of this additional tax increases as the say time period increases. If you file within first assessment year, it is 25% of your original tax liability. Second year, this is 50%. Now, third and fourth year, what they are saying, 60% and 70%. Okay. So, whatever is your original tax liability, 70% of this needs to be paid additionally, and then the updated return can be filed up to say end of the fourth assessment year. Okay. Now, I feel this, I was talking in India also, that a professional community, even in India, has not appreciated this concept of updated return properly, where this whole concept would be relevant, and where as a tax professional, I would like to advise to my client to exercise this particular option. Some of these ideas I would be sharing. So, first of all, this is 25, 50, 60 or 70% kind of thing. Up to 4 years, you can file your updated return. For example, if there is this AY 21, 22 kind of case, today I cannot file this updated return because today the time limit is 2 years. 1st of April 25, the window will get open even for AY 21, 22 also. I will be having time till 31st of March 26 to file that updated return. Okay. Now, sir, two things are happening very importantly in this whole Indian income tax scenario, which have got a direct relation with this concept of updated return. A, that they are having huge information now available with them, sir. Huge amount of data they are generating. Practically every single financial transaction we are doing in India, and everything is getting reported. If you are having some say familiarity with the say procedural aspect of Indian tax system, they have introduced this whole concept of AIS TIS since last 2-3 years, annual information system, which is actually, sir, Janam Kundali, which gives you every information. And number of times this is happening in India. I am telling to my client, yeah, tera Bank of Baroda mein bhi account hai. You have got an account in Bank of Baroda also. Sir, how do you know? He is not aware. I know. Okay, you have got say some shares of ITC also with you. Sir, I don't know, but it is there. Probably your father might have purchased and then some transfer has happened and something like this. So, huge amount of data they are getting. Okay. Now, based on this huge amount of data, now regularly notices are being issued. And nowadays, what we are having that assessment system, that the scrutiny assessment, the next year assessment, they are not say very bullish on this. They are more on this reassessment. After 1 year, 2 year, 3 year kind of thing, they will issue a notice that you are having this kind of income, you have not filed your income tax return. So, please explain. Now, there are two options available to me. I can simply ignore that particular notice, whatever they are giving. Now, because everything is computerized, everything is visible to whole of the departmental hierarchy, if a notice has been issued, they are not going to leave it. So, if this happens, that somebody has got this notice that you have got these many kind of transactions and you have not filed your income tax return, or you have not disclosed your income properly, that the disclosure in ITR is not commensurate with the information we are having. So, for all these cases, either you have an option to ignore it or to contest it, go for an assessment, go for litigation and everything, which will be a costly affair because they are having a very clear-cut information. Or in that scenario, you can use this concept of updated return that, okay, I have got this transaction done. I couldn't furnish the information earlier. I couldn't disclose it in ITR. Now I'm filing my ITR. Okay, the updated return. There would be a cost involved, 25% in first year, 50% in second year, 60 in third, 70 in fourth. But that would save the client from the penalty proceedings. That would save the client of likely prosecution proceedings also. So, this is another thing which is happening in India a lot. We are getting good number of say prosecution notices also. They are simply using that particular power also, which was till now a dormant sleeping kind of mechanism, but they are using a lot simply to create that pressure. So one can always take a chance to contest this whole information. I am not going to accept it. Let me go through that whole assessment where there is a say penalty mechanism of say 200% of your tax liability. As against that possible 200%, we are talking about this 15, 25, 50, 60, 70%. And just to clarify, this 25, 50 is not of income. This is of tax only. So if 60%, actually it comes to 18% only. Yes, sir.
Through this updated liability, the different, the 25%, 50%, 60 or 70% will be on the differential amount or the original?
This is the another point I would like to come, more specifically from say NRI's perspective. But before this, there was one more query. Yeah, please.
What if we haven't filed a return? Can
Yeah.
we still file a return as an updated?
Updated return, yes. Both the cases, they give you an option. Not filed the return, then also you can file. Already filed, then also you can update it. Okay.
Now, if we have already filed the return, and I don't know what is the assessment procedure, because in refund case, immediately within 2-3 months you get the refund.
Right.
I don't know whether the assessments are done digitally for everybody, and it's not done.
It's not. It's a simple processing of return only.
Okay, let us say at some point of time, it is assessment is done, then we instead of going for
Updated return.
updated return, you have to contest that in a different section, correct?
Right, yeah. So, but sir, then this will depend upon, say, the quality of information they are having. If they are saying you are having, say, dividend from this kind of thing, I'll share some of, say, real life example I'll share. Dividend income, say, stock market transaction. We are, say, you might be knowing it better, but what we are seeing, good number of NRIs are, say, indulging into this, say, stock market operations in India.
Information is available.
Because there's this whole, say, you can do through a simple app kind of thing. So huge, and we understand. You even if sitting in Muscat, but you understand India very well. So you know what's the Reliances, you know Infosys is, you know TCS is. So good number of NRIs are doing this online transaction.
AS26 is giving online.
Yes, yes. So if you had done all these kind of, say, stock market transactions, not filed your income tax return or not disclosed these transactions in the income tax return, then probably this updated return would be a better option. In any case, you won't be able to contest it. It is everything is there, open and clear. So you have simply ignored to say disclose it in the ITR. Then you would like say no, I'll contest it. Jo hoga dekha jayega. Not going to work. Sir. Yes, sir. Time limit for issuing such notices, 5 years maximum, sir. Up to 5 years they can issue these notices. There is this whole reassessment procedure, section 148, capital A. So up to 5 years, up to 3 years for any amount, beyond 3 years, more than 50 lakhs. Right. So that's what I'm saying, sir. Depends upon the quality of information they are having. Say for example, we are having number of issues where non-residents have purchased say movable property in India. For this they have issued the notice simply because I was not having any income in India, I have not filed the income tax return. But I have purchased say movable property 50 lakhs, 60 lakhs, 70 lakhs of rupees. They got this information from registrar of properties, sent a notice. In that case, obviously, there is no tax liability, there is no need to say go for all these updated return. The only option would be contested. Simply disclosing the say sources, I have sent this money from USA, from Muscat, from Oman, from Dubai, this transfer has happened. These are the sources of say me purchasing the property. So this is one category of assessment where you have a say clear-cut case available with you, no taxable income. But say there are a whole lot of these other cases. Good number of NRIs, and I'm saying from my professional experience, good number of NRIs, all these stock market transaction during COVID period particularly, nothing else to do, so simply buying and selling, and say gains are there. So then probably it will be difficult to challenge it, sir.
Sir, so this updated return can be filed even after receiving a 148 notice?
Even after 148 notice, yes. See, there are two aspects of this 148 notice. Before issuing 148, nowadays they are giving you a 148A show cause. that this is the information we are having, give me your response. So after having that 148A, before it gets converted into 148, in that period you can file this updated return. Just to make things clear, with this new amendment, they are saying if the this is say 3 years period has already expired, then this facility would not be available. After 148A, you won't be allowed to file updated return in the new amendment. But up to 3 years kind of period is there, 148A is there, it has not been converted into 148. In between, you can file updated return. That has been amended, sir. That amendment has already been done. Last year, I think they have amended this. Yeah, 139.4 can be now 139.5 also.
Sir, just a clarification, 50 lakhs is the income escaping assessment, that's the limit.
Yeah, after 3 years. Yeah.
Sir, in case of stock market transactions, normally these transactions are happen through the demat account in bank.
Right.
When the transaction settles, that time the bank, associated bank itself will take the TDS.
I'm coming to that point. I think Sir has also raised this point. So this is the point number 2. Specifically from NRI's perspective, how this updated return concept is going to be much more useful. Because now what is happening, if say you have done all these transactions through a demat account, disclosing your status as non-resident, all these transactions you have done, there is already a TDS which has been done by the bank. The only problem is this, this whole income tax return has not been filed at all. Let's assume this thing, no return has been filed despite of having these say stock market gains and a TDS associated with this. Okay, now there is a notice. Department is not aware that there is a say associated TDS also. They are simply looking at you are having this much kind of income, no income tax return is there in my system. In that case, this becomes much more suggestible to go for this updated return concept, because this whole 25, 50, 60, 70 is required to be paid only on that additional tax liability. If there is any extra tax payable, in all probability, because of this TDS already been done, there is no further tax payable by me. So in fact, there is no cost also associated to it. Simply filing an income tax return will complete that cycle. There is this income I am offering, this is the TDS which I am claiming, no further tax liability is there, and then the simple updated return can be filed without any additional tax liability. Having said this, sir, there is one more catch to it, sir. Tax laws are not that much simple. There's one catch to it. So the point is this, you can do this, sir. Okay, so there is this income and then there is this tax liability, TDS, so you adjust. So ultimately my tax liability comes to 0. Now there are 2 aspects to it. So there is a refund also available now. So updated return they have introduced for their facility, not for your facility.
There is a penalty for not filing a return.
So one thing they have made it very, very clear, there is no refund which is possible. So yeah, let's take the benefit of this 4 years period, let's enjoy, I'll get my refund also, this is not.
Refund interest also will ask.
Then you will asking interest also.
There is a penalty, no? If you don't file return.
There is a penalty, this 5,000 rupees penalty you need to pay for not filing your say returns on time. In all probability that penalty would also get adjusted within the TDS itself. You can use the TDS. Now, having said this, there is another catch to it, sir. The things are not that much simple. They say updated return has to be filed only when there is actually a tax liability. Rather than a refund, there has to be a tax payment also. You cannot file an updated return with a refund. You cannot file an updated return with 0 tax payable. There has to be a tax liability also. Now, the point is this, tax liability, that means any amount. Obviously. So the whole idea is obviously is say even if you are having whole amount of TDS, you are not going to get any refund. You are simply doing it for the sake of compliance to save yourself from that further penalty prosecution. So don't claim whole of the TDS, just to claim that much TDS which leaves us say 100 rupees tax payable. 50% additional to it, 150, they will be very, very happy, sir. No, this is amongst the closed doors we are talking, sir, amongst the tax professionals only. Madam, तुम मस्कत जाके सिखा के आ गई है.
No, this is basically for those people who have a lot of B money and they want to convert.
No, no, sir. This is basically for all those persons. This is the actually where it needs to be used in all these cases where the income taxable is there in India. Somehow you haven't filed that income tax return. You have failed to file that income tax return despite of having TDS and everything. In any case, you have not filed your return. So refund in any case is not available. You yourself has taken a call not to file the income tax return, to refund to you yourself as ignoring. The only point is this whole TDS you can use to save yourself from those hassles which may be there later on.
From the TDS process.
From, because for NRIs there is a mandatory TDS. If it's a resident client of mine, then because there may not be, for resident, for all the stock market transaction, TDS is not there. So if he is having a set tax liability, then he has to go to this 25, 50, 60, 70% additional payment also. For NRIs, because the TDS is already there, so just make sure to ensure the compliance, at least that compliance would be over, your name would not be there as a non-filer kind of thing. Just to remove that tag, this is what needs to be done.
Sir, previously they used to give time within which you have to declare your income. अभी वो नहीं आप कभी भी सुधर सकते हैं.
Yes, this is a permanent weakness they have created.
आधा करके
So this is one particular concept which has been developed over say last 2-3 years in Indian income tax, given further impetus to this particular budget, updated return, which I would like you all to say, take a say detailed note about this. Okay, then I think one or two changes, something like this. Then there is this whole idea of TCS on foreign remittance. Okay, from India, if you are doing this foreign remittance, the TCS is being done. One thing, number of banks in India are asking for this TCS, even in case of NRI remittance also. The law is absolutely clear. This whole foreign remittance TCS is not applicable for non-resident. We are having two accounts there. One is NRO account, one is NRE account. If there is a foreign remittance happening from NRE account, very clearly TCS is not applicable. Number of banks are still having a problem, but you can always talk to them, you can always convince them that the TCS is not applicable with respect to NRE remittance. Any completely repatriable. As an NRI, you are repatriating money from NRO, or I as a resident in India is remitting money to anybody else outside India, then only this TCS would come into picture. Till last year, this limit of TCS free exemption, till last year, this limit of TCS free remittance was 7 lakhs. Now they have increased it to 10 lakhs kind of thing. Okay, so these are some of the say major changes which have been done with respect to budget 2025, finance bill 25. There are good number of changes with respect to charitable organizations, some other procedural aspects of penalties and everything. I don't feel we need to go through to all those things. Okay. So then with this, I think this is a part one of my discussion. Let's start to this another topic of discussion. Do we have this say slide changer? You will change it. Okay. So something about this whole idea about NRI taxation. Okay, a topic which is say close to my heart also. So I'm actually thankful for giving me this opportunity to share with actually the audience where it is needed. Okay. See, and I feel, sir, even as a tax professional also, there are good number of aspects which we miss with respect to this whole idea of NRI taxation. So probably majority of my discussion would be going to be a say refresher of whatever you might be already knowing. But still I would like to highlight some of the say specific areas which should be given a detailed say attention. Okay. So what I see, what it needs to be seen with respect to this NRI taxation, sir, I'll be sharing this whole presentation. It is already there. So probably the pictures may not be needed as such. Okay. This may be shared, sir. No issues. Okay. So what is the very first basic idea we need to see, sir? Whenever we talk about non-resident taxation under the income tax, it is not only the income tax which needs to be seen, the treaty is also required to be given the equal weightage. This is probably the first mistake lot many people commit, because I am so say comfortable with the say income tax act. whole of my CA studies, I have say rectify this whole inter and final and everything, section, something like this. So Income Tax Act as such is say I'm absolutely comfortable. But when it comes to non-resident taxation, the treaty also needs given the similar level of importance, if not less, or if not more. It has to be exactly level. So there are two aspects of this whole NRI taxation. One is this 61 Act, which is now going to be replaced by 25 Act, which gives me the idea about residential status, what is the scope of my total income, what all special provisions are there. And then there is this DTAA, which in fact overrides income tax in number of cases. Section 90 is very clear, whichever is beneficial, that needs to be adopted. Okay, so I can go for wherever I get a higher benefit. Okay, yes. So now let's quickly come to income tax, where some important amendments have been made 3-4 years back with respect to residential status, which I would like to clarify about. Again, there is a whole lot of confusion created by social media. So first of all, who is a non-Indian? NRI, what is the exact definition? Individual, citizen of India, or PIO who is not a resident. Non-resident Indian, simple definition. Okay, there is always an issue with respect to this PIO, person of Indian origin. I am not a citizen of India. I do not have say passport, but still I am PIO. So who exactly are PIO? They say himself, any either of his parents or any of his grandparents have born in undivided India. So this person is PIO. There is always an issue with respect to grandparents also. When we talk about grandparents, we are talking about paternal side, or we are talking about maternal side, or we are talking about both the sides. With respect to section 56 gift, there is always this issue. But so far as NRI is concerned, the Act's language itself gives me a very clear-cut indication. When they talk about parents, they are talking about either of the parents. When they talk about grandparents, they are talking about any of the grandparents. So language itself is clear. They are talking about more than two persons with respect to grandparents clearly. So any of these four, or parents or himself, born in undivided India, the guy is PIO. Along with PIO, if you are resident, non-resident in India, or you are Indian citizen, non-resident in India, you are NRI. Okay. Now, who is non-resident? For being an NRI, I need to be non-resident. In income tax, we do not have a positive definition of non-resident telling me these persons are non-resident. They tell me who is not resident in India. Anybody who is resident, who is not a resident, he will be treated as non-resident. There is no who are the non-resident, but there is who is resident, then they will treat me as a non-resident. In between, sir, and for us, there is this whole concept of NOR also, not ordinary resident. There is R, there is NR, and there is NOR. Now, where does NOR gets fit? For all practical purposes, NOR is a resident. Because that amendment which they have made by Finance Act 2020, that is creating a major issue with respect to NOR. So it is good to have that clarity that NOR for all practical purposes is a resident. Only for some limited purposes they are being treated as NR. But if I am NOR, I am actually a resident for various purposes. Okay. Now come to the residents. Who are the resident in India? Section 6. We may go back to our say CA final or CA intermediate days, but there is a very significant change which has happened. These last two columns, so probably the last column from say Oman and GCC perspective, which I feel should get us a greater attention of everybody here. The first column is probably you all can correlate who is resident in India. India more than 182 days in the current year, or more than 60 in current year plus 360 year 4 year, they are resident. This was a age old criteria. Then they have added two more conditions from AY 21-22, Finance Act 2020. Now they are saying in the second column, if I am having income from Indian sources more than 15 lakhs, if I am in India current year more than 120 days plus earlier 4 years more than 365 days, I will be treated as a resident in India. Earlier the requirement was this: if I am a non-resident, I'm staying outside India, every year I could have been there in India without getting into residential status up to 182 days. Now what they have said, earlier 4 years you are there in India for 365 days. Current year you are in India for more than 120 days and you are having income from Indian sources more than 15 lakhs, you will lose your non-resident status. And probably the third column is more relevant. Again, you are having, say, income from Indian sources more than 15 lakhs and you are not liable to pay tax in any other country because of the reason of your residence or domicile or any other criteria of similar nature, you will again be treated as a resident in India. So third column becomes more important for all the, say, at least GCC countries persons where they are not liable to pay tax in this same country because of no personal income tax applicable here. And then this non-resident who is, for example, a resident of Oman or Dubai or Qatar or something like this, more than 15 lakhs income in India from Indian sources, you will be treated as a resident in India. We'll come to it. So capital gain is a treaty issue. So we'll come to it. Okay. But this is the first thing. This is the change which they have introduced. Because of this change, the point is you will find a good amount of, say, misinformation online. And this is saying that this will create a very big problem. More than 15 lakhs income, you are resident in India, so global income would be taxable in India. Returns disclosures are required to be done. This is an amendment they have done. This is a, say, blow they have created, but then they have softened this blow. That is also required to be seen. As again, repeating, sir, income tax, never draw your conclusion reading one section only. It has to be the complete act, then only you will come to the final conclusion. So this is the first point they have said. We are focusing for all practical purposes on this third column only, because which is more relevant for all of us. So what it is saying, if your income from Indian sources is more than 15 lakhs, you are not required to pay tax in any other country, then you will be treated as a resident in India. Having said this, then they give me in subsection 6. Section 6, this was section 6.1 we have discussed just now, section 6.1 and 6.1a. Now this is 6 subsection 6, where they are saying that any person who is a resident because of subsection 1a, he will be treated as a resident but not ordinary resident. This something very important, sir. Not many people are talking about this. You will see all these things online. You will see everybody is say, ignoring this particular aspect, but this is something very crucial for us to understand. This is the situation now. Because of section 6 subsection 1a, they are saying that if you are not liable to pay tax in any other country and having income more than 15 lakhs in India, you will be treated as a resident in India. 6 is now softening that blow, saying that though you will be treated as resident in India, but you will be treated as not ordinary resident in India. So this NOR status suddenly become very, very important for us. Now I need to see, now I need to understand very clearly, yeah, what is this NOR all about? In my CA examination, probably I have not paid that much attention to this NOR, but now this becomes very, very important, what this NOR is all about. So 1 minute, then I'll take your query. Okay, so now what is the difference being an NR and NOR? If I am NR, then my income neither accrued in India nor received in India is not taxable. If I am NOR, then also more or less same status continues. Only what will be taxable for NOR, income received in India, taxable. Income accrued in India, taxable. Okay, any income accrued outside India from a business controlled from India or the profession set up in India, that will be taxable. But all income which is not coming into this category, which is accrued outside India, received also outside India, even if I am NOR, the income is not taxable. So what has happened, sir, after that amendment through Finance Act 2020, AY 21-22, whole amount of hype has been created, particularly for GCC countries, persons, that if you are having more than 15 lakhs income in India, your Dubai income would also get start taxing here, global become taxable, all those issues would arise. Nobody has read that subsection 6 of section 6, which is saying that though I am resident because of that 15 lakhs income criteria, but I am NOR, I am not ordinary resident. So being an NOR doesn't change much, except those treaty issues, which will come later on, except those treaty issues. Being an NOR doesn't change much. It simply disentitles me from treaty benefits directly. Indirectly, still those benefits would be available, but directly those treaty benefits would not be available. So this is the first thing with respect to NRI status. What is my residential status? And based on this residential status, what would be the scope of my total income? Because of that 15 lakhs criteria, they might be treating me as a resident, but still I'm NOR only, and being an NOR, not everything would become taxable in India. Okay. Okay. So this is what I thought. This is a development in, say, yesterday night's flight. Sitting in the flight, I just thought I should develop a specific slide specifically for, say where I am delivering this lecture. So impact of amendment in section 6 for Indian citizens resident in Oman. You can replace Oman with Dubai, with Qatar, with any GCC country for that matter. Okay. This is basically to counter that disinformation which is there online. So just to generate a clarity of tax professionals. So if your income from Indian sources for the year does not exceed 15 lakhs, okay, sir, I do not have this. This total income, yes. So, but total income equals to taxable income.
Interest accrued on NRI deposits.
Yeah. That means, so total not in the mathematical perspective, whenever I talk about total income, it means taxable income only. So, section 2 of income tax. So, total is not mathematical total, it is income tax total. Yeah. So, taxable. For all practical purposes, we are talking about taxable income only. Okay. So, if your income from Indian sources, taxable income from Indian sources is not more than 15 lakhs, then you can absolutely relax. Then there is no need of, say, thinking about what changes they have done. It is only when you are having more than 15 lakhs income, then this whole issue would be relevant. Okay. So less than 15 lakhs, that old scenario will continue. Up to 181 days in India, you can enjoy your non-resident status. Only when you cross that 181 days period, then you will get into that residential status less than 15 lakhs. If income is more than 15 lakhs, then the issue arises. Then you will be treated as resident, but not ordinary resident. So even after being treated as NOR, income accrued and received outside India, whatever is the Oman income, GCC income, absolutely no tax liability in India on this. All these reporting of foreign bank accounts, foreign assets, etc. would not be applicable. That FA schedule would not be applicable of income tax return. The only problem may be with respect to the treaty benefit. Okay. Then the treaty benefit, because this will be now a dual residency case. You are a resident of India also because of that 15 lakhs criteria, and you are a resident of Oman also. So there will be a dual residency case. Then whether treaty benefit would be available or not, that would be decided as per that tie-breaker rule applicable in the treaty. Okay. This is a, say, the simple one-shot kind of table in order to find out this whole impact of, say, those changes. There's probably, again, you can recall some CA final kind of, say, table we used to create during our study days. Yes.
I'm sorry, actually I want to ask a question away from all this, but connected. I mean, just one small.
Okay.
Don't you think this is a disincentive for NRs to start investing and making money in India?
So I think there are say two answers to it. One is, being a tax professional, I normally refrain from commenting policy issues, sir. As a tax professional, my job is to say implement whatever government is saying. So there are lot many mature minds than me sitting in government who are having their own way of looking at it. And then probably I feel this, because of say this NOR status has been given, it will not create that much of impact. So yeah. So next one. If I get a chance, sir, you arrange a meeting, I will be happy to tell her. You call her here. Yeah, next one. Okay. No, this same thing. Okay. This is about with respect to say non-resident. Now, some other key provisions applicable for non-residents. If I am actually a non-resident in India, yes, sir. I'm coming to it. I'll be talking about it, sir. Yeah. Okay. So this is, right now we are discussing the act, then we will come to treaty. Okay. So from act perspective, they give me three major exemptions as an NRI. My NRE account income is absolutely tax free. My FCNR account interest is absolutely tax free. And then gift city matter. Okay, now they allow me to have a say savings account in gift city also. Okay, FCNR is basically a foreign denominated fixed deposit account kind of thing. If I want to have a savings account in foreign currency, they allow me in gift city. So any interest I am earning in that gift city account, that is also tax free. So three major exemptions. Apart from this, are some other special provisions, this whole idea of presumptive taxation of various kind of business. One we discuss right now, the new amendment, foreign airline, foreign shipping business, civil construction with power plant. Some of these say special presumptive taxation provision, not of say much wider applicability as such, but these are some special benefits for non-resident. There is this dividend which is taxable at the rate of 20% under 115A. If I am a non-resident earning any dividend income, I can always take the benefit of one. Tax would be 20% in this particular case. As I already mentioned, TCS on foreign currency remittances not applicable. Banks in India, a great amount of confusion. Any foreign remittance, they require the TCS to be done, but not account. If any remittance is being done, then TCS not be applicable. Okay. Some of the facilities which are not there for non-residents. This is also we need to have a clarity about. As I already mentioned, that 87A rebate, that 12 lakhs, no you people, sir. I can enjoy, not the non-residents. Regime, higher tax limit, higher exemption limit for senior citizen and very senior citizen. Again, they define senior citizen being a resident in India. So even if you are a 3 lakhs income or 5 lakhs income tax free for senior citizens, not for non-resident, that is only for the residents. Okay, this whole LTG, STCG, this is something important. Okay, say for example, now up to 4 lakhs, even in new tax regime, there is no tax liability. I am having a long-term capital gain income. As a resident in India, if I am having say 5 lakhs long-term capital gain or say short-term capital gain, anything, I can always claim 4 lakhs exemption against that special rate income. Only on balance income, I will be paying tax. This facility is again not available for non-residents. Okay. So for example, you are having a long-term capital gain from stock market transaction. For that long-term capital gain, 1,25,000 exemption is specifically for long-term capital gain that you can enjoy, but that no other income is there. And then you want to say my income is less than 4 lakhs, no tax liability. This is not possible. So for example, there is a say all in all 3,25,000 kind of long-term capital gain. 1,25,000 you can claim under section 112A. Balance 2 lakhs still this will be taxable. You cannot claim exemption of that 4 lakhs of rupees against the special income as such. Okay, and then last year, they have changed this whole idea of indexation also with respect to long-term capital gains. Okay, earlier there used to be this whole concept of indexation available. Now this indexation is available only for land and building, that too only for the resident in India. So if you happen to have any property in India, might have purchased say 20, 30 years back, you may like to claim an indexation benefit against this, but as a non-resident, now they will not allow you that indexation benefit to you. So these are some of the cases where residents can get that benefit, but not the non-resident. I can tell you what is happening because of this whole say indexation not available. There is this number of persons who are settled outside India. Now they give you an option actually nowadays with respect to this long-term capital gain from property without indexation 12.5% or with indexation 20%. The mechanism they have introduced. In number of cases, particularly old time properties with indexation 20% comes out to be beneficial. But the problem is this, non-resident cannot avail this particular option. I came to know number of cases where the deals are happening. Son is settled somewhere in USA having a say property in India. If he sells, he won't be able to enjoy that benefit of indexation. So they are gifting it to their parents first, and then the parents are selling that particular property. Because in case of gift, you can still take the indexation from the date of say original person. The cost of acquisition of original person can be taken. In some states like Maharashtra or somewhere, the stamp duty implications are also not much on this say transfer of on gifting of property. So this is one thing which has came to my knowledge. This is what is happening. Whether income tax department to what extent they will be seeing it favorably, but lot many people are doing this as of now, because non-residents cannot claim this indexation benefit. That is available for non-residents also, sir. Yeah. Okay. Now coming to some aspects of this DTAA. So 5 more minutes? Fine. So coming to this DTAA treaty, which I feel, sir, I would like to emphasize it again, in my understanding, never gets that much attention which should have been given. Okay. We never see it clearly. It should be given that equal weightage. So for example, with respect to this Oman DTAA, these are 4 income for which there is a special provision. Okay, you are earning any dividend income in India, you can claim a treaty benefit, pay taxes only at the rate of 12.5%. Okay, this will obviously applicable when your income is into that particular slab. Okay, as per this new slab of system, the say up to 12 lakhs, there will be normal rate is already 10%. Only when your other income is more than 12 lakhs, and then you want to, there is a dividend income also, you can claim that treaty benefit. The rate of tax would be 12.5%. So say for example, there is some rental income in India, which is already around say 15-20 lakhs kind of thing. So that 15-20 lakhs of rental income would take care of this normal slab tax income, then dividend can be treated as a taxable under treaty 12.5%. Any interest you are earning, the taxable rate is 10% only as per treaty. Okay, royalty, fees for technical services 15%. Any professional services, independent personal service, what they call, okay, sitting in Oman, if you have got some client in India giving some professional consultancy to him, that whole professional services are not taxable in India, sir. As per treaty, all these income are taxable in country of residence, which in your case happens to be Oman. So this is not taxable in India. Doesn't make any difference, sir. Received is a concept of Income Tax Act. Treaty overrides Income Tax Act also. Okay. So all these income, yes, sir. Yes, sir. So, the last line, sir. The last line. There is a schedule SI in ITR, special income. So for all these first 3 income, you need to mention these income into that particular schedule. that will give you a drop down where you are taking the special rate, what is the rate applicable, everything you can mention there. If it is say last one which you are claiming is exempt, then there has to be schedule EI which needs to be used. Because nowadays CPC is a problem there, this income tax return processing. So unless it has been disclosed properly, the benefits may not be available. So there is a specific schedule they have created, special income, where this all needs to be reported. Okay. No, 12 lakhs is that 87A is not applicable for you, the slab. So say in case you are having only dividend income, up to 12 lakhs slab would be beneficial for you. So what you can do, you can always have a bifurcation. Up to 12 you should not be reporting in that SI schedule. That will be your normally taxed income. Balance 3 lakhs you can claim in that SI schedule, whichever is beneficial. Mind you, the section 90 is very clear. If slab is beneficial, you can go by that. So revised return up to 31st December only. Updated return they won't allow you. So for last year all these facilities are gone. You should have called me earlier, I think.
Queries, specific queries after the session, the speaker will.
Yeah, 5 more minutes.
Go
Yeah.
ahead with the flow, and then you can take your queries later on. Okay, thank you. Please, sir, continue.
Yes. So these are say one set of benefit. Second benefit which is available in treaty, and this is something with respect to capital gains. This is a very interesting wording provision, sir. So sometimes even I fail to understand how these provisions get inserted, but it is there. Law of land. You also can read it in that India Oman DTAA. For capital gains, the in the state in which it is situated. So India property selling taxable. In they say wherever the company you are selling shares of an Indian company, taxable in India. The last point is important. What they say, gain from the alienation of any property other than that mentioned above only in the state in which the alienator is a resident. I leave it to you to take an interpretation, sir. Whether it actually means what all are understanding, but this is like this. What they are saying, all other capital gain taxable in the state in which you are the resident of. So all other assets, very obviously the first example comes in mind is mutual fund. So strictly speaking, the mutual fund transaction should not generate any tax liability in India. Because of this treaty, this is taxable in the state of residence, in the home country, which happens to be Oman in this particular case. It is very clearly written in treaty.
It's exempted if we get the residence certificate from Oman.
Take the benefit of treaty. So, two benefits which are there. First is with respect to this capital gains. Now the documentation which is needed, what needs to be done? One is you need this TRC, tax residence certificate. In Dubai now they have formalized a process how to get the TRC. I am not very sure about Oman, whether this process of getting this TRC or not. I would like to be enlightened on this from you, sir. Online you can get it. Okay. Just to say complete the discussion, in India we have got some tribunal decisions at least which are saying that if no formal TRC is there, any other document which can prove your residency, even that should also be acceptable, but that's a litigation issue, that's a debatable issue. We do have, say, tribunal decisions on this point only. Also, so as per law, what is needed is a TRC. Along with TRC, there is this form 10F which needs to be generated from income tax portal. Okay, by logging to that income tax portal, form 10F is required to be generated. The point to be noted, again amongst the tax professionals, these forms are not required to be submitted along with the return. They say you need to have it. So in written, they simply ask you to tick whether you have got TRC, yes. They are not going to ask, they are not going to submit it along with the written, but you need to have it. This is what is the legal position, sir. Okay, we can remove it. Okay. Now, it is this tiebreaker test. Now, because of that NOR issue created, having income more than 15 lakhs in India, there is this whole NOR. So it's a dual residency kind of thing. Now, because of that 15 lakhs criteria, you are resident of India. Because of period of stay, you are resident in Oman. So then there is this tiebreaker test which is applicable in the treaty itself. How to decide a residential status? They give me a state, please. Okay. So he shall be deemed to be a resident of the state in which he has a permanent home available to him. Now, see, if it comes to it, even I would like to argue on this proposition. They are not saying permanent home owned by you. It is available to you. So it might be owned by me, but not available to me. Might be a say litigious proposition, but this is what they are saying, in which he has a permanent home available. If he has a permanent home available in both the states, there also and here also, then where is the center of vital interest, where I am having a higher income kind of thing, just to simplify, where my income is high. Okay. If he does not have permanent home available in both the states, or center of vital state cannot be determined, then wherever is the habitual abode, normally where I am residing, that will be the country which will be. These all are step by step. You go out from the first step itself, further steps would not be applicable. Tiebreaker test, yes. I think by and large, one of these three steps would determine what is the residential status kind of thing. Okay. Personally speaking, I have rarely seen matters go to this particular extent. Okay, income tax department raising a query to this particular extent. Personally, I have not seen these kind of cases, but this is what is the law applicable. Okay, so if he has an habitual abate, we can remove this. So this is what is the say brief idea about say income tax treaty benefit. What all are the benefits available, when it can be taken. I think we can take one or two more issues and then I'll finish it off. Okay, important compliance for non-resident. To obtain a permanent account number, I have seen number of cases where even PAN is not there. The banks are regularly deducting TDS. That TDS is going in the no man's land. You are wasting that TDS unnecessary. So need to have a PAN, submit it to the bank properly, file a income tax return, updated return. I have already given that particular idea. Foreign assets are not required to be disclosed. There is one great confusion, sir. If I have to file this income tax return, whether I have to disclose all my foreign bank accounts, everything, no. That schedule is applicable only for the resident, not for non-resident, even not for not ordinary resident. Ordinary residents only are required. So absolutely no problem as such. No further disclosures are required to be given. Okay. NRO to NRE transfer, sometime bank insists this whole 15 CACB kind of submission. Technically speaking, it is not needed, but bank required. So some of these are important compliance for non-resident. I think we can skip this. Yeah, next one. Okay, next one. Some common mistakes which I have observed. I fail to understand why as an NRI people keep money in NRO account. But there are a good number of persons having say huge money lying in NRO. What is the fun? I fail to understand. You have got equally say clear-cut opportunity available with respect to NRE. It requires a simple transfer, a simple instruction to the banker, but there are a good number of people having money lying in NRO, particularly in GCC countries. Either here or in USA, but for GCC countries, NRE account in tax not payable in India, not payable even in home country also. So this is probably the first mistake one can commit of say lying in an NRO account. Absolutely no need. Okay, non-submission of PAN to the bank. You don't have a PAN, you don't submit it. Bank deduct. this whole would be lost unnecessarily, okay. Not filing ITR, I have already mentioned this. Purchase of agricultural land, so this is a FEMA issue. Number of say non-residents are buying agricultural land which is absolutely restricted. You cannot do it. Even if you have done it, there might be problems later on. At the time of sale, the registrar may have a problem. Even if it has been sold, happen later on. The clear title to the buyer also. So that's a very big risk. I know number of persons have done this. So the whole problem with the immovable property is this: once it gets tented, the tent will always remain with this. You convert it, you sell it, you develop a colony, whatever you do, you never know. There is no limitation period. They may come after the NRI after 20 years also. So that's a risk. One has to take proper calculation, the agricultural land kind of thing. Probably buying it in the name of somebody else, some relative, some directly buying it. Having said this, I know number of people are doing this. Because say, if you have to invest in land, it is only the agricultural land which will give an appreciation. Nobody would be buying what is called a pakka jameen. The appreciation would always be only be there in the agricultural land. Non-resident, absolutely not permitted, sir. You cannot even go for permission or something. It is not allowed. Okay. So I think this is what I am having. Anything else, sir?
Is there any move towards clubbing husband and wife income somewhere?
So ICAI has permitted it, but they have not accepted it. This is one say slide I have created. NRI is returning back to the India. First 2 years you will be having that NOR status. So you need not to say pay tax on your worldwide income. Only after completing 2 years period, then you will be normal resident. The Indian income would also start getting taxed. One again important problem we have observed: those who are returning back till 2 years you are NOR. No foreign asset disclosure, everything. From 3rd year onwards, you are normal resident. Then all those foreign bank account disclosure would become mandatory. There is a penalty of 10 lakhs rupees per year for not disclosing foreign bank account if you are required to do it. It's a State Away Black Money Act case, sir. So that needs to, and lot many people make a mistake. All these say USA people returning back, having some bank account there, not disclosing it, may land you into a serious kind of problem. So this is something about NRIs returning back to India. Yes, sir. So last one, next. Thank you from my side. This is what is, sir, my submission. Thanks. Thank you very much for giving me this opportunity. I'm sorry if I have exceeded my time limit, sir. Thank you. Thanks a lot, sir. So my pleasure. My pleasure is entirely mine.
Near 31st March, maybe we should have one more session with you. Tax planning for NRI. This is what you have given the provisions. So how we can plan. So just since we are short on time, we will take questions during lunch session. I am being the MC. I'll take that advantage or disadvantage, and I'll ask couple of questions. Maybe it will be applicable for most of them. I have paid tax in last 4 years on my sale of mutual funds. So
okay.
After seeing that slide, probably I can revise the updated return and I can.
So through updated return, you cannot claim the refund. That is the problem.
Revise.
See, revised deadline is over, 31st December.
Let's say if somebody having a huge, let's say 1 crore holding in mutual fund, then can they sell that now and move that to GIFT City, because there is clarity that whatever income generated in GIFT City, there is no tax. So just to avoid that ambiguity, or the further investment in mutual fund, if I can do through GIFT City.
Sir, GIFT City has got some restrictions also. So I'll suggest say a proper detail analysis of that whole GIFT City provision. Probably somebody you can call again who is having a more expertise onto this GIFT City. There is some minimum investment requirement. This much needs to be invested. Then only you can go to GIFT City. Something like this. So considering this, if possible, you can go.
May I welcome Sri Nihar Jambusaria, past president of ICAI, to take us through the direct tax.
The chairman, vice chairman, and the entire managing committee, all the members of Muscat chapter, and let me at the outset congratulate the Muscat chapter for consistently getting the best chapter award from ICAI. And as the previous speaker also mentioned, this requires perseverance, consistency, and hard work year after year. I'm sure that the new chairman will also make it a point to see that this legacy is continued for the chapter for the future years also. So with this, let me again, before I start with the bill, thank the Muscat chapter for inviting me to speak on a subject which is not so well explored so far, because the bill was just presented last week, and there are about 622 pages to the bill and almost 23 chapters. To really decipher the bill in detail, one needs to go through each and every section and compare it with the existing section. In the limited time, we have done the exercise because we were knowing on what concept the government was going. Again, before I start, let me also thank Muscat chapter that when they invite me to Muscat to speak, there is always a pleasure of sharing views on some topics related to the profession. But at the same time, there is another perquisite. My younger brother stays here and I get the opportunity of staying with his family for some days and spend some time. So with this, I think before I start with the nitty-gritties of the bill, I will answer one question which was raised by a member, that earlier in 2009, when the government initiated direct tax code, we were all thinking every year that maybe next year the new direct tax code will be introduced. It never came, and somebody made the comment that Tiger was still alive. I think, let me just share my information on the direct tax code which was proposed in the year 2009 and which is being proposed now. If that direct tax code was introduced, I think in 1.5 hours or 1 hour's time, it would not have been possible for any speaker to give even a bird eye view of the difference. Because that direct tax code was supposed to be rewritten. Complete Income Tax Act was proposed by the government to be completely rewritten or new written. The concepts were very different, and the question that why it slept for so many years. The reason was that earlier the Congress government, then BJP government, evaluated on merits whether that direct tax code should be introduced, and if it is introduced, what will be the consequences. And they felt that whatever positions were settled legally over so many years would be completely disturbed, because the concept of income in that code was different, concept of allowing expenses was different, concept of allowing exemptions were very different. The language was completely different than the language of the current Income Tax Act. And it would not have been possible for the country to settle down with the new law for another 50 years. So then government thought, let us leave aside that direct. Anybody has the copy of the earlier direct tax code which was published for public comment, you compare with this code, it is completely different. Now in this income tax bill, it is not even a code. The way it is introduced, It is introduced as the Income Tax Bill 2025. And when it will be passed and it will become the Act, it will be known as the Income Tax Act 2025. So earlier we had Income Tax Act 1922, then it was replaced by the Income Tax Act 1961, and the 1961 Act is sought to be replaced by the Income Tax Act 2025 when this bill is passed. Now ideally, in the presentation I should have used word clause so and so, clause so and so. As long as the bill is not passed, all the sections in the code, in the bill, become section when the bill is passed in the parliament. But for the sake of clear understanding, because it appears as if 90% of these provisions will be passed as it is, there won't be much difference. And the reason is that if we compare this bill with the Income Tax Act 1961, what is the objective? Let us see why this bill is being introduced. So, the bill aims to simplify the current tax system, and I am coming straight to this without indulging into the other aspects, because I am told that now I have exactly 1 hour and a very few minutes. So, in that, let me present the concept and make you understand as to what are the differences between the Income Tax Act and the new bill. So it aims to simplify the current tax system. How it aims to simplify? It is not that the sections are redrafted. They are not completely redrafted. They are calibrated. And in the bill you will see that some of the explanations and provisos, they have tried to incorporate those explanations and provisos in the main section itself. So you will find that in most of the sections, some of the subsections which you read, they are exact copy of what is there in the explanation and proviso of certain existing sections. They have removed certain provisions. For example, here there was a reference during the discussion on finance bill that some provision was there up to 23rd July to 2024. So the current Income Tax Act will mention that this provision is applicable up to 2024. But the new Income Tax Act, when this bill is passed, it will not have reference to 2024 at all, because whatever is expiring before 31st March 26, by 31st March 26, it is contained in the Income Tax Act 1961, and it is not required to be carried forward in the 2025 Act. Otherwise, you and I will be reading the Act in the same way in which we are reading today, that we are so much disturbed that while reading this section, in between they will say, now this subsection is removed, now this subsection has sunset clause. So in order to avoid that, whatever has become absolutely obsolete and which is not applicable now, they have completely removed from the income tax bill which is proposed. And this next line that you see, and which may surprise you, that from 819 sections, how they are being reduced to 536, because all those obsolete provisions are going out of the new act, and that is how the number of sections are getting reduced to 536. This should give us a lot of comfort in reading the act. Its size will be reduced and we will not have to read some of the information which is not at all necessary for us. Then 40 to 50% reduction in word count, how they have achieved, because all these provisions are completely going out of the new act, and that is how the word count has also reduced, and this should give a lot of comfort. then many explanations and provisos are removed. This I just told you that whatever provisos, explanations they have retained, most of them they have incorporated in the main section itself. So the section is made more readable. Every time you don't have to look at the conditions, look at the explanation which is separately given. It is incorporated in the section itself. Then there is a shift from previous year and assessment year to tax year. And even yesterday when we came and we were traveling, this question was asked that what is different by the Vice Chairman, that how did previous year make sense up to now and how it will not make sense going forward. So the answer to this which I gave to him and I am telling you because we are dealing with it, in fact the concept of previous year and assessment year was relevant only up to 1989. When earlier, 1989 or some earlier date, till the time we had the choice of selecting our accounting year, our previous year. Previously in India, a person could end the accounting year on 31st March or on 31st December or on 30th June. But then government cannot have a system which taxes every taxpayer on the basis of a different previous year, different tax year. So that kept tax year constant. All these year endings, those which ended in June, December, March, they were all linked to a common assessment year. And that is why this concept of previous year and assessment year was required till that time. It could have been removed even earlier also, but now they are taking the step of removing it because it is not required now for every taxpayer under the Indian Income Tax Act. The previous year is common. The tax year is common from 1st April to 31st March. Even if your income starts from in between the year, the first year will end on, or the first period will end on next following 31st March. And that is why now we will always have reference to tax year and it will simplify our understanding. Here so far nobody has asked, but somebody may have in mind if you have gone through this bill, that just now 2 years back in the reassessment provision, and Manish ji also dealt with it, that the period for reopening is 3 years and 5 years. If the income escaping assessment is more than 50 lakhs, up to 5 years. Now in the new bill you will find there is reference to 4 years and 6 years. So the first impression that you get is that just 2 years back they said that we don't want to keep it up to 10 years, 6 years, so we want to reduce it. So why again it is increased to 4 and 6 years? It is not increased. See, at present it is 3 years from the end of the assessment year. It is 5 years from the end of the assessment year. Whereas now it will be 4 years from the end of the tax year, which currently is previous year. So it is the same, it is not increased. So I am clarifying here, at that time I will not have to deal with it again. Again, where it is made 6 years, it is with reference to tax year. So if you go by the old concept of assessment year, from the end of assessment year 5 years, it remains the same. There is no difference. Then some of the jargons and complex terms, like notwithstanding anything contained in any other part of this act or any other provision of this act, it is being replaced by irrespective of anything contained. I think we are now used to notwithstanding also. So if it is irrespective of anything, perhaps our future generation will be benefited. But for us, probably it does not make any difference. But let them have the fantasy of having simplified, and let us also pet them for what they are doing. Somebody also asked Manish ji to represent before the finance minister that why they are keeping this 15 lakhs plus of limit and restraining investment from other countries, because people will feel why they should become resident of India while being outside India. I think there is little background. Manish ji rightly said that if you call finance minister here, he would be happy to represent. But there is little background to it which I will give, and perhaps you have all heard about the rigidity of the government, how much they listen, how much they are flexible is known to everybody. But the background of this has come from the concept of BEPS, which was introduced, base erosion, profit shifting. And you know, there are so many provisions under the BEPS which are being introduced by countries, several countries, those who want to adopt those principles. You would also know that India was always advocating source-based taxation, whereas many advanced countries of the world were advocating residence-based taxation, which now President Trump has also realized that source-based taxation is better, and that is how he has created tariff war also. So those countries advocated the principle that if you earn something using the resources of my country, then my country should have fair share of tax. Now, very rightly put by you that in the race of having fair share of tax, whether we are losing investment in the country is a question which government should consider and have balancing between the two. See, on the one hand, by putting such a provision, beyond 15 lakhs, you become NOR. You may be able to collect some more tax, but is it desirable? Because you collect more tax, but some of the investors may run away. So if investors run away, that much resources which are available in the form of investments from abroad would get reduced. Now, in the current finance bill also, if you see indirectly, see on the one hand, rightly put that middle class was always having a feeling in the country that it is the most neglected class in the country, and everything that comes in the form of suffering comes to the middle class. Poor and rich are the least affected. So benefits should be given to middle class. That was one. But while presenting this, one very important statement that FM made, and for the first time, I thought that some right thinking has gone to them, that by reducing the rates of tax or by making the slabs more favorable to the middle class, about 1 lakh crore of money will be left in the hands of taxpayers. Now, here the government thought, or it was one part of the thinking, that some less will come to the government. But 1 lakh crore, which is left in the hands of citizens, once it is left in the hands of citizens, either they make investment out of it or they spend out of it, and it creates chain effect. And the economists have proved that 1 rupee left in the economy produces 7 times more, because it gets circulated 7 times. It is reinvested. If you make even a fixed deposit with bank gets multiple times capacity to lend. And that is how 7 times the resources channelize in the country in a year. So the question that somebody raised, rightly the government should think that we want to go by MLIs, multilateral instruments. We want to adopt the principles of BEPS. But every step that you take in collecting tax from the income generated from sources within the country, whether it is fetching good revenue to the country or leaving it in the form of investment in the country, would give more benefit to the country. So this is a question, a principal policy question, which is debatable, and of course our institute post-COVID, particularly I remember during COVID, when particularly in India, the MSMEs were closing down one after the other. And I remember the place where I stay, on the ground floors of many buildings where there were number of shops, they were closing down. The government came to the institute and said that you have branches all across the country. Let your chartered accountants come out with a solution how to protect MSMEs. In any country of the world, MSMEs contribute not less than 40% to the GDP of the country. And if MSMEs start dying, then the economy would really collapse. 40% is not a small share. So in the same way, we can advise government by making a thorough analysis and presenting a picture, whether by calibrating provisions with the aim of collecting more tax, you are really benefiting the country, or by leaving this amount in the hands of taxpayer, you are expecting the country to benefit more. It's a debatable question. One has to make thorough survey of situations and put before the government a white paper which would enable them to take right decision. Of course, rigidity of government is another issue, but then if we put right proposal, perhaps some thinking may change at their level. The next is formulas and tables are added to explain key provisions. And many of you would have referred to India-US treaty. And Manish ji will agree with me that the explanatory memorandum to India-US treaty explains so many clauses in the treaty so systematically that for advising clients, all those illustrations which are given in the explanatory memorandum are very useful. They, to an extent, curtail litigation. So here they have made an attempt to put things in tables, in formulas, in schedules attached to the Act. Schedules are increased from 18 to almost, I think, 47 or 57, which is a good step, which will increase our understanding that if a particular provision is to be interpreted, if an example is given, the government intent will be understood. And then, it will enable us to take decision as to whether they challenge this provision, which is illustrated in the table, or to follow the table and avoid litigation and buy peace. So better understanding of the provision one can have in the form of what is government thinking behind a particular provision if one refers to these tables where examples are given, where formulas are clearly given. Then next is residency law remains unchanged more or less, except that at a later stage there is a slide on residential status. There is one change which we will discuss whether it impacts, and perhaps even you would be interested in knowing what is the possible impact of the change. But I'll come to that when we reach that slide. Then existing provisions for exemption under section 10 are now contained in separate schedules. So to give you example, leave salary, gratuity, their exemptions were in section 10. The formulas were in rules, and leave salary or gratuity is part of salary head. So now they have tried to link even the exemptions with the particular head of income. So where the salary head is there, in the schedule pertaining to salary 2 and 3, the leave salary gratuity provisions are there. And later on we will see even charity trust. We had provisions scattered over so many sections of the Income Tax Act. Section 10, 23C, Section 11, 12, 13. Then, on anonymous donations and others, rates of taxes prescribed in Section 115, BBC, BBD, BBE. So now what they are trying to do is even charity, it is under one chapter. Anything related to charity you see in that chapter or schedule related to that chapter, so that you don't have to search. Charity provisions had become so draconian after the CIT exemption was given the power to cancel registration. Whether we have forgotten to apply some provision, whether we are violating some provision, in various parts of the Income Tax Act you keep hunting. And at the end, when you come to the conclusion you have not violated anything, still there is a doubt in mind whether I have missed anything. And if some notice comes from CIT exemption, at that time you realize, oh, I missed this. And even today, in the existing law, in section 12AB, where they have said that these are non-permissible things. If you do this, your exemption, your registration can be cancelled. So these provisions are very dangerous for big trusts which have become of the size of corporates. It is very difficult. Now, with this kind of exercise, that anything related to charity, you look at either that chapter or schedule related to that chapter, your job becomes easy. You don't have any doubt in mind that any part of the act has some hidden provision which I have missed. To that extent, this bill will certainly simplify our understanding of the act. Now, whether all this that they have done, whether it was done on their own, the answer is no. As I said, after 2009, our professionals only made the government to realize that the old direct tax code which was drafted and put for public comment, it was so substantially different from the current act that it will disturb all legal positions which are taken so far, which are approved by the court. So they started consultative process. Even our institute suggested that in the existing act you remove unnecessary sections, remove reference to provisos and explanation. Even so many industry representatives contributed, and there were about 20,976 online suggestions for simplification and removal of redundancies. These, one minute, and these were classified into policy related, language simplification, removal of obsolete provision, and then they carried out the exercise. Meetings with industry and professional associations were done, and then now we have the updates available. In residential status, as I said, this is the change. And this is a small example, and we may just look at what possible intention there could be in modifying this. At present, if an Indian citizen leaves the country during the previous year, now it will be tax year, for the purpose of employment outside India, shall be considered as resident only if he was in India for 182 days. That 60 days condition will not apply. For the purpose of employment outside India. Now they are changing this to for employment outside India. So very apparently it looks like it is simplified, but there is a possible meaning to it, for the purpose of employment. Now suppose I leave India during the tax year, and the words are for the purpose of employment. I may not have any appointment letter in my hand, but my intention is to come to Muscat, search for a job, and I claim that I left for the purpose of employment outside India. We also have some judgments which say that employment includes self-employment. So even if I come here and start my own business, I am self-employed then. So I left the country for the purpose of employment outside India. So if I leave the country, and suppose it takes 1 long year for me to find out a job or to start some activity here. Under the current provisions, I was able to argue that the time limit for stay in India to be applied to me in the year in which I left should be 182 days, because my intent was very clear. I left for the purpose of employment outside India. But now, for employment outside India, whether will it mean that I must have appointment letter in my hand, or I must have license to start my business here, and then only I should leave? So of course this is an open question. I am not saying that it will mean exactly that way, but this requires deliberation. In professional circles in India, debates have started on several sections. When they presented, we did not have comparative existing section and new section. Now on the website it is available. So even we are listing, institute is asked to give its recommendations on this. I think Manish, you are also perhaps invited to give comments. So we should give comments and we should have deliberations whether it will make my situation difficult and whether we should ask government not to disturb existing position. So this is one example. This is what is proposed in the bill, and this is where probably even we will ask the government कि here जो भी था उसको रहने दो, let it be as it is, because this is a settled position. And if your intention is clear, you want to allow Indian citizens to go out of India, not treat the person as a resident. If the intent is to settle down in foreign country, then let the words for the purpose of remain there. So this is one position. Next.
So this would also impact all the investor visas, right? Which is not deployment, not self-employment, but just people having residency because of the investment visas, property visas.
But there you can, even under the old and the new provision, you can argue that even if suppose you start investment activity, after all it is self-employment. With your money you are doing some activity using your intelligence. So it is not necessary that we have several judgments on this, that it is not necessary that you leave the country and take up an employment in the foreign country. You may start business, you may start profession. Even investment activity, one can always say that it is self-employment.
No, but if there is no activity, there are visas where you just buy a property and just stay. You're not doing any activity.
Difficult to argue that you left for employment.
Because those are very prominent. Those are taking place, like golden visas.
Yeah.
People are just buying property and staying.
So in that case, it will be 60 days limit which will apply, 60 and 365. That exemption of that second condition will not be available. Yeah. Yeah. Yes. According to me, employment visa under this language is not required. See, you may live on a visa which is other than employment, other than permanent residence, but ultimately, if your intention is to go there, search for a job, I have seen so many Indian chartered accountants who moved to Australia. They took 1.5 years to get job and they were staying with relatives. But even when their return was filed, they left after, say, October, after September. They were not there for 182 days, but they were there for 60 days. They were successfully able to argue that my intent was this and I have achieved it finally. So, the fact that when you argue that I have left for the purpose of employment, at the very point of time of leaving, you should have exactly that visa. That requirement, so far as income tax is concerned, is not required. Where you finally establish that you have gone out, settled down there, and either you had employment or you started your own activity. Then number of schedules, from 14 they are increased to 16 to provide separate linked schedules to every head of income or every chapter. Number of tables are increased from 18 to 57. So many illustrations are given. Number of chapters are reduced from 47 to 23. Now chapters are reduced because of removal of so many obsolete provisions. Salary related provisions are consolidated in one section. This example I gave, that the exemptions related to salary are all bundled in schedule 2 and 3. Then of course this is there in the income tax bill, but it is there in the finance bill 2025 also, which was presented on 1st February, that in salary income we had age-old provisions, section 17 subsection 2 clause 3 subclause C, which said that if an employee has monetary salary not exceeding 50,000, then any benefit or amenity granted or provided free of cost or at concessional rate by employer to employee will be tax free. Now 50,000 monetary salary is a very low limit. It was set in 1970 and it required revision. So in this finance bill, they said that this 50,000 limit is being removed, and they are providing that this limit will be prescribed by CBDT from time to time. The same provision they have retained in the income tax bill, that for any employee, for benefit or perquisite to be taxable, now the limit should be much higher than 50,000. Maybe they will raise it to 10 lakhs also or 5 lakhs, whatever. It depends on CBDT's mindset. Again, there is one important point in this bill, that the FM mentioned while presenting the bill, that now year after year they will not amend the provisions of the Act. So many amendments will be left to CBDT. Now in the past, actually what they should have resolved is that whatever is being provided in the Act, they will keep it constant for 5 years and review after say 5 years. So there is continuity. And you have seen that approach in Finance Bill 25 presented on 1st February, that whatever time limits are raised, now they are not raised this year by 1 year. They are raised by 5 years. So they could have done that. Now our past experience shows that whenever they left anything to bureaucracy, it has created lot of confusion. Because once this power is given to them, they again make provision that this will be scrutinized by officer and decided. This will be left to the discretion of tax officer. Now, if these discretions are left to tax officers, then more and more disputes will come up, and for obvious reasons that you know. So that they should have avoided, they have not done that, and they are saying that this limit will be left to be prescribed by CBDT. So many changes now, probably in between the year, will be done by CBDT. Let us see when this bill is finally presented in the Parliament, how many powers are given to CBDT, how many they retain with them, and what will be the future will depend on that. Next, we will. Then income from other sources. Now in the new bill, all these sections are contained from sections 92 to 95. Only today, if you tell anybody, कि ये इसको पैसा दे रहे हो, just check 56,210, anybody would know that you are gifting, but whether it will be treated as income. But now that exercise is redundant because of remembering the old sections. We will have to remember new sections. Chapter remains the same, but the section numbers change. Here also there is some change in the language where earlier they used the word dividends. Now they are replacing it by any dividend. And in the discussions that we had, see earlier in other sources where it was plain dividends, at many places it was possible to argue it will not include dim dividend. Whereas now any dividend would cover wherever in the act any dividend is treated as dividend, it is dim dividend, it would be covered. So again, we will have to see where exactly a particular payment will fall within dividend and what kind of havoc it may create. Those of you who know Indian Income Tax Act, you know how draconian 222E is. Dim dividend under section 2, clause 22, subclause E, where a closely held company gives loan or advance to a shareholder holding 10% of voting power or more, it is always to be deemed as dividend. Whether it is repaid with interest, whether it is repaid in 15 days, it will be treated as dividend. Now, this word any dividend, anywhere, any amount which is covered even by deemed dividend provision would be covered. So this requires actually the entire list to be made and to be demonstrated that what you don't want to achieve can be achieved if you use the word any dividend. So this is another example. One thing they have rightly done, Manish ji also mentioned that in other sources where lineal ascendant or lineal descendant was not defined clearly, now they say that on parental side, maternal side, lineal ascendant, descendant both will be included. In the new bill, it is very clear. Next, we may see. Capital gains, again there is change in the section. Certain redundant provisions they are removing now. This I gave as an example that it will not appear in the new act because in the Income Tax Act 61 it is covered, and anything which is applicable up to 23rd July 24, it is applicable till the act, the old act is applicable. So in the new bill they have removed so many provisos and subclauses are either removed or they are incorporated in this section itself. Next we can go through. Transfer pricing. I think here there are some provisions which may interest you and this we may discuss in little more detail. Now, one is chapter number, section number is okay, but we go next. Definition of associated enterprise, deemed associated enterprise, international transaction, and deemed international transaction are on similar lines. There is some language difference in the definition of deemed associated enterprise. The new section starts with the phrase without affecting generality of the provisions of subsection 1. Now, those of you who deal with transfer pricing would know, because if there are transactions with associated enterprises in India, then you were required to refer to section 92A1 and 92A2. Now, for this purpose, I will just open this section and demonstrate what could be the meaning of this change. So, see, in the words are retained from the existing law itself. And I will read it out for you. In 92A1 what is laid down is also laid down in 162(1) of the new bill. So see what they are providing here. And I am reading this, going in little detail because this would impact you. In this chapter, associated enterprise in relation to another enterprise means an enterprise which participates directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. Subsection 1 provides this way. Now in subsection 1 there are two clauses, A and B. B goes one step further, that if there are common persons controlling two different enterprises, participating in the control of two different enterprises, even these two enterprises are associated enterprises. Then subsection 2 lays down. Now listen to this also carefully. Without, this is now new provision, without affecting the generality of the provisions of subsection 1. This part was not there in section 92A2. So 92A2 started with the words that two enterprises shall be deemed to be associated enterprise if any, at any time during the tax year, one enterprise holds directly or indirectly 26% of the voting power in the other enterprise, any common person holds 26% of voting power in two enterprises, then both will be treated as associated enterprises. Subsection 2 gives illustration. 26% of voting power, 51% of borrowing, guarantee to the extent of 10% of funds borrowed, then the other enterprise will be deemed to be associated enterprise. Now what we were arguing till now, and we have contradicting decisions, that when subsection 2 of section 92A lays down that this 26% voting power and 51% of borrowing, when these conditions are laid down, only if this condition is laid down, subsection 1 will apply. Then if these conditions are satisfied, then you look at whether actually these persons are controlling the other enterprise or not. So double jeopardy to the department. They were not treating subsection 1 and 2 independent of each other. And arguments were made that if I satisfy deemed associated enterprise condition, then you have to again look at whether I am actually controlling. Then only the relationship is that of associated enterprise. Now what they are saying, these words are added, without affecting the generality of the provisions of subsection 1. So where I actually control, although I don't have 26% of voting power, although I have not lent 51% of the total borrowing, but if I am actually controlling the affairs of the other enterprise, that enterprise is my associated enterprise. And if I satisfy those conditions, if I have 26% of voting power, whether I control or not, the associated enterprise, the other enterprise will be regarded as associated enterprise. This is the implication. So this is important for those dealing with transfer pricing provisions from the year 26-27. If this is passed as it is, then the meaning will change. The earlier arguments will not be available. So this will be important. Next we can. These are all more or less same, only calibrated and written in separate, bundled into one section. And again what Manish ji said, this we are living with the branch chapter. So you may email it to all participants. So 1 minute, the last part. Now, wherever there are slight changes and calibration, I am not dealing with it. But see this concept of benefit of plus or minus 3%. is going to be available under the proposed bill in case there is only one comparable. So if you have more than one comparable, the safe harbor of 3% plus or minus will not be available under the new law. Under the old law, even if you have more than one comparable, you could have exercised safe harbor up to plus and minus 3%. It won't be available. Then, yeah, one more point, that if suppose by the most appropriate method of computing arm's length price, you arrive at more than one ALP, one arm's length price, more than one, then law is very clear, and it is required to be clear, that in that case the arm's length price will be arithmetic mean of all those multiple prices that you have, multiple ALPs that you have computed. There is clarity that under the most appropriate method there are formulas, and I get two different ALPs. Take arithmetic mean of the two. If I get 3, take arithmetic mean of 3. Now they are saying that if you get more than one ALP under the most appropriate method, then the ALP will be computed as prescribed by CBDT. So again they are leaving this power to CBDT, and they may come out with methods which you may not have experienced here. But Manish ji, we have section 9B, retirement of partner. What kind of computations, calculations, how complicated, how confusing they are. See, even now when I applied these provisions 2 years back, suppose a case of retirement comes to me today and asks for computation of capital gain, I may have to refer the entire provision once again. It is drafted in such a way, it can't stick in your mind. So when it is left to CBDT, what kind of complicated method it will prescribe, time only will tell, and whether then the simplicity will be achieved or not is a question. So again, I would suggest the institute should recommend, don't leave so many things to CBDT. Prescribe clearly in the law. If I have to take arithmetic mean, even if I am at a loss, at least I buy peace of mind. But if it is left to formulas which will be given by CBDT, amended from time to time, and that too, if they are ambiguously drafted, it will create a lot of confusion. Next. Then the same fabric is retained, what Manish discussed, that you have the choice to go by the or by the treaty, the choice whichever is beneficial, it is left to the taxpayer. Then yeah, it means the same thing, that DTAA is signed by countries to give relief to the taxpayer, and that is why wherever treaty is more beneficial, you can opt for treaty and not go by the act. Next, फिर I think this is an important amendment there or provision they are proposing. At present, what is the position that if any term is not defined in the double tax avoidance agreement, in the treaty, then you get the definition in the Income Tax Act. If it is not defined in both, then today the position is you go by any notification issued by the central government. Now they are making the position little lengthier, but you have to follow the steps. Now what they are saying is, if term is used in agreement, any terminology is used, for example royalty, and is defined both in the agreement and in the bill, it will have meaning which is provided in the agreement, in the treaty. Where it is defined in treaty, you go by treaty. You know, on meaning of royalty, what kind of ordeal we have undergone. I don't know whether payments to you, whether they are royalty or not, payment from India to your enterprise. In the Finance Act 2012, when Mr. Pranav Mukherjee introduced those explanations, transponder payment, then your holding in a company up to certain percentage, creating, royalty situation. Then that is the meaning of royalty given in the Act. And on so many positions, particularly transponder payment, even payment for computer software, where you have bought on the shelf software, whether it is royalty. Now, if you go by Income Tax Act section 916 or 7, it would be royalty. But then if you are covered by treaty, where royalty is clearly defined, you were safe, because royalty was liberally defined in the agreement as compared to the act which was amended in 2012. So now this section 159(7) is making it clear that if any term is defined in the agreement and act, both go by the agreement. If any term is used in the agreement that is not defined in the agreement but has a definition in the bill, then go by the definition of the bill. Now, I am referring to this as act because ultimately it will be passed as act with some modifications. If it is defined in the act, go by act. If it is not defined in treaty. Third, if any term is used in the agreement and is neither defined in agreement nor in the bill, it will have the meaning given to it notification of the central government. If central government has notified, go by it. Next, if any term is used in agreement, not defined in agreement, bill or any notification, it will have meaning given in any act of the central government relating to taxes. So go by the definition in the GST law or customs law or any other tax related law where it is defined. Then it is further mentioned that meaning assigned to such undefined terms shall be deemed to have effect from the date on which agreement came into force. So take example, treaty came into force from say 2015. Term is not defined in Income Tax Act, not defined in the treaty, but GST law in 2025 for the first time defines that terminology. Whatever is the definition in GST law, it will apply right from the time the agreement was. So in all pending cases, that definition will apply. Those cases which are concluded and have become time barred, they are out of the purview. Then next, assessment related provisions. Now this is just showing that what was the old section and what is the new section. Wherever there is difference we will discuss, but otherwise this is comparative sections list. So we'll go to the next slide. Ashish, next. Scrutiny assessment, similar powers are given. Similar powers are given in 271. Section 153A and 153D are omitted because in the Income Tax Act also now these provisions are not applicable. Block assessment concept has come in. So in the new act, there is no need for reference to these sections. You will not find it there. Next. Charitable trusts, as I said, see the different sections. Certain rates of taxes are prescribed in 115 BBC, BI, TD. Now you will not have to refer to these distant sections. Everything is contained in chapter 17B at one place. The provisions are just the same, except that in the current income tax act, you have reference to a charitable trust, institution, educational institution, medical institution, hospital. Instead of that, now they are using only one word, non-profit organization, NPO. So this also will become easy. All these charitable institutions, if the objects fall within the purview, then it will be regarded as NPO. You need not find out whether it is hospital, educational, or what. And even otherwise, section 23C and 11, which were overlapping with each other, and the government thought they are not required. In the new act, there is only one exemption provision, and this overlap is being removed. Next, we can. This I have given in the form of chart. So if you want, you can refer to this chart. It will make it easier for you to see the charity trust provisions at one place. Next. Now on DRP, we were expecting exhaustive provisions because government again and again stated the objective that we want to resolve many cases at resolution panel itself so that this litigation reduces. But if you look at the DRP provisions in the new bill, they are more or less the same, except that the DRP, when it issues directions, now the bill makes it clear that these directions should be in writing, and the directions should state points of determination, the decision, and the reason for decision. So it should be a speaking order by DRP to the assessing authority, instead of just a one-liner approved, not approved, or following changes to be made. Reason for every change that DRP wants to give as direction. But substantially, otherwise the law is the same. It has not improved much. People thought, like arbitration, we will get one good chapter on DRP and we will not have to go for litigation every now and then. Next. These are permanent account related provisions. Now they are all, 3 sections are clubbed into one section, and the only change is that now if a person does not have pen, then a person can quote Aadhaar number, and even after a person may continue to quote Aadhaar number, which is a sort of convenience given. Now if you give your Aadhaar number, I do not know whether the requirement of having pen can be avoided, because in TDS perhaps there is no reference that if you don't have pen, but if you have quoted Aadhaar, higher rate of TDS will not apply. It will apply. So the requirement of having pen remains there, except that wherever on documents you don't have pen and quote Aadhaar, this convenience is available. But I think at a later stage probably CBDT will specify that within a prescribed time limit have pen allotted and link it with Aadhaar. Next, penalty provisions. The only change in penalty provisions is that this is okay, 5%, 20%. Where you don't have pen, TDS and TCS will be deductible or collectible at higher rate. That provision is there in the current law. It will remain in the next bill also. Only one important change is that at present, you know that if you want to apply for lower rate of TDS, lower rate deduction certificate or lower TCS rate certificate, only certain sections of TDS and TCS are covered. You can't apply for TDS on every section. But now they are providing that for any TDS deductible, any section, you certificate. This was recommended all professional bodies in India, that why you leave out certain TDS rates from application for lower rate certificate. So they are trying to achieve it in the new law which is being formulated. Next will be tax returns. One major change is that today in the law it is very clearly prescribed in section 139 that if you have done foreign travel, turnover or gross receipt exceeds threshold limit, then you are required to file return of income. Now they are removing this from this section, but whether CBDT will prescribe situations in which you do not have taxable income, but you have done foreign travel, you have done anything like this, that your turnover or gross receipt is above the threshold limit, taxable income below the threshold, still you may be required to file return. But that again you have to see whether CBDT does it in future, but they are removing it from here. Actually, there was no need for them to say that if you conduct a foreign travel, you must file return. Because today, if you do a foreign travel through AIS, they get information. You make specific inquiry, who funded. Now suppose my father has funded my foreign visit, or suppose this chapter has funded foreign visit of myself and Manish ji. Why, if our taxable income is, or our income is below taxable limit, why we should be required to file return? You have access, you find out, or you ask specific question, we will reply. So if they remove this requirement, it is good, because now with technology they have all information, and whatever inquiry they want to make on one-to-one basis, they can seek clarification and avoid the whole process of filing return for so many citizens who are not taxpayers. Then CBDT will be given power to seek details of credit card expenditure exceeding threshold outgoings, particulars of principal place of business. So when this power is being given, why requirement for filing return? Next, this we have already discussed, that for any deduction of tax under any section, you can apply for low rate deduction certificate. Yeah, next. Repeal and savings I am not discussing. Whenever any old law is discontinued, the provisions for savings are always there, and provisions for repeal. Repeal means the old sections will not apply from a particular date. So everywhere they have laid down that all these provisions will discontinue from 1st April 26. At the same time, to give one or two examples of savings, you incurred a loss, say in the current system and in previous years, say 24-25. It is allowed to be carried forward for 8 years. And from 1st April 26, the new act will come into force. So they have made provision that all these provisions for carry forward of losses and other provisions which are required, they are saved in the new act. One more example, like you have TDS deducted, say for the financial year 25-26. And you know that if you don't declare that income in that year, but according to your method of accounting, say in 26-27. So the law is very clear. You will get TDS credit in the year in which you declare the income. So that provision is saved, that if tax was deducted earlier, but you are declaring income under the new act, then you will get credit for TDS. So these provisions are technical. Now I think next is also repeal, and this is just pictorial presentation of what are the new schedules, what they cover. So there is no need to discuss this. And then I also thank all of you, but there are some points, and still time permits. So if for 5 minutes. In fact, technically I was asked to conclude by 1:30. It is 1:34. I'll take 3-4 minutes to just deal with some provisions. Actually, in seminars it is said, in lighter vein I am saying, whether you start on time or not, but conclude on time. People have their lunch time, tea time, everything fixed. So I will go by that spirit and conclude in very limited time. Just 2-3 major things which I have not covered in the PPT, but I have noted, because this bill is so lengthy that everything you can't cover, and when the time given is 1.5 hours, you may have to later, even for Muscat members to understand, have full day seminar also to discuss the entire bill. Now, see, one good thing that they are doing in the new law is that you know that non-resident shipping companies and aircraft companies have to compulsorily declare their income under the presumptive tax provision, section 44 BBA, BBB. So now what they are providing is similar to 44 AD and ADA for the low people who file return under presumptive tax, that if they want to declare income lesser than what is prescribed in the presumptive tax law, then they can file return with lesser income or declare loss, but prepare accounts and get them audited. So this option is being given to non-resident shipping and aircraft companies. At present it is not there. It is mandatory, even if they declare loss, they have to declare income as per the certain percentage of gross receipt. So this is a good option that they are giving. Then one bad thing that they are doing is, at present if one company receives dividend and that company declares dividend, then the dividend declared is given as deduction under section 80M. They don't want to give this facility under the new act to those companies which pay tax under new regime, that is 22%, or manufacturing company at 17%. They will not get deduction under 80M under the new law. I think this is bad. If the dividend is redistributed, it should be allowed as deduction. Then next is clubbing of income. There was one confusion, and time and again it was represented, that if a person is substantially interested in a concern and that concern pays any remuneration to the spouse of this person, then unless the spouse possesses technical or professional skill and applies technical or professional knowledge in carrying out duty, it will be clubbed with the person having substantial interest. So spouse could be husband or wife, whoever. Again, they are retaining the same provision, whereas it was suggested, and I think in the initial draft somewhere it was mentioned that they will clarify that professional degree is not required for this purpose. A person can achieve professional skill or technical skill without having professional degree. They are not clarifying in the bill. Perhaps this is one point where clarity is required and it needs to be represented. In reassessment proceedings, at present where the assessing officer was supposed to obtain approval of higher authority and had not obtained, and straight away notice was issued, that notice was challenged and courts held it is not a valid notice. Now they are introducing a process to validate the proceeding even if originally approval was not taken. I think this should not be done because then it enhances power. Casual notices will be issued, later on they will regularize. This should not be given to them. Then one more thing which is not in the interest of taxpayers is that they can reopen an assessment and issue notice where there is information on hand regarding some income escaping assessment. Now what they are saying that this information will include even directions given by approving panel declaring a particular arrangement as an impermissible avoidance agreement. You know GAR, which was introduced. GAR is the byproduct of BEPS, but then every country in local law has introduced GAR in one form or the other. So India also introduced that if any of your transaction is declared as impermissible arrangement, then it will be ignored and they will treat that transaction as null and void and compute income as per the decision of the panel. I am not discussing threshold limits and other provisions. Now suppose for a particular past year, the approving panel declares a particular arrangement as impermissible arrangement. Now with this, even for a later year, if the assessment is complete, suppose similar transactions are there, the officer will get the chance to reopen the assessment, because where the approving panel passes a direction that this particular transaction is an impermissible arrangement and you add it to the income, for subsequent year based on this he can reopen the assessment. Otherwise, technically if you look at what is information, it will not fall within information because that transaction pertains to a particular year. Similar transaction for next year, not necessary that it will be impermissible arrangement. So, and in income tax there is no res judicata, that particular thing for a particular year is the law for all subsequent years cannot be taken for granted. One or two points for block assessment, the time limit to pass block assessment order, which was 12 months from the end of the month in which last authorization was issued. They are increasing it to 12 months from the end of the quarter in which last authorization was issued. Of course, block assessment provisions are not so relevant here. If anybody faces unexplained income, then you know that in section 69D, there is a provision currently that any loan taken on hundi or given on repaid, taken on hundi and repaid, otherwise than by an account paycheck, that is otherwise through banking system, will be treated as unexplained income. That is the current provision. Now in hundi loan, they are expanding the scope and removing the word hundi loan and putting negotiable instrument. Any loan taken through any negotiable instrument and repaid otherwise than by banking channel, it will be treated as unexplained income and will be taxed. And one more provision which they want to introduce is not as per the principles of natural justice. They are generally providing that for levying penalty, the requirement of giving opportunity of being heard, they are removing. Whether courts will hold it valid is a question. I think they will rethink and probably reintroduce. And prosecution, when they launch prosecution, what they are providing is that it will be considered as a non-cognizable offense. You know, if a person is charged with murder, even without a proper filing of FIR, can be arrested. So now prosecution, if department launches, you will not have any option. Straight away they can arrest. It is non-cognizable offense now as proposed. So these are some of the provisions. One provision which will impact you, those who are in foreign country and those who create private trust for the benefit of dependents. At present, private trusts are not taxed at maximum marginal rate if the trust is created for the benefit of a dependent relative. Now they are saying that even if it is created for dependent relative, it will bear tax at maximum marginal rate. Some good tax planning was happening. Previously, people were creating multiple trusts. So then they came to the situation that if it is created for dependent relative, then no MMR, otherwise MMR. Now they are saying even if you create for dependent relative, MMR will apply to the income of the trust. So these are some of the major highlights. And I must finally thank Muscat chapter for giving me the opportunity of coming here and sharing views. Thank you. Thank you.
The earlier 1961 income tax law had around 500,000 words. So Nirmala ma'am has simplified to now I think 2.6 lakh words. So still 50% reduction, but still it is. And thank you on such a short notice, within a week you could put up such a detailed presentation, and really thank you. May I now request and all MC members as well on stage.
For being here with all our members on a short notice. Actually, we should give them a big round of applause. Change is the only constant thing, and we just witnessed one change, and hopefully there are no changes in coming future once it is approved. So that leaves the litigation part to bare minimum, and everybody is able to enjoy the provisions throughout the year without significant changes happening every year. Let's keep our fingers crossed for CBDT not to issue too many contradictory guidelines, to keep it simple. So with this, thank you everybody for joining us for this session. Though it got delayed, I'm sure it's worth the delay, right? Those who agree? Yes. And we thank the hotel management, our sponsor CBFS, our supporters who are mentioned here. And I would like to repeat one statement what our past president Sunil Talati ji just mentioned in the last international seminar. East or West, Indian Chartered Accountants are the best. Okay, with this, thank you everybody. The lunch is being served, and we'll just have one small presentation for the winners of the competition. I request Nihar ji and Manish ji to be on the stage to please hand over the gifts to the winners.
There are some students who are
Oh, we got it. Yeah. Yeah. So what we have started is those students who were given their CS certificates with the signature of Nihar ji. Do we have the names, please? Come. Give me your certificate. Let me check first.
No, not you. Nihaji has to check.
Yeah. So let me announce the name. Come.
Come, you have to check. You don't have to.
Vaibhav Lathia, please. Anyone else?
So memorable to him.
So he's one of the youngest member. One of the youngest member of our chapter, getting the certificate from the youngest president. Okay, may I have the name, please?
The winners of volunteer game. Sanvi. second winner was Vanaja Rani, but I think she is not there. Do we have Faisal Mohammed? Faisal Mohammed here. I request Manish to hand over the gift, please. And last but not the least, we have Suresh Kumar. So I request Sangeeta Suresh to be on the stage and CA Nihar to hand over the gift.
Yeah, on behalf of my husband.